Forward and futures contracts. Forward and futures contracts are fundamental derivative instruments in financial markets, serving critical roles in risk management and speculation. At their core, both are agreements between two parties to buy or sell an asset at a predetermined price on a specified future date. The asset could be a commodity, currency, interest rate, equity index, or even another financial instrument. Defining forwards and futures. A forward contract is a customized, over-the-counter, OTC, agreement between two parties to buy or sell an asset at a specified price on a future date. Because they are private agreements, their terms, such as the amount, price, and settlement date, can be tailored to the specific needs of the parties involved. A futures contract, on the other hand, is a standardized agreement traded on an organized exchange. Like a forward, it obligates the parties to buy or sell an asset at a predetermined price on a future date. However, its standardization and exchange-traded nature introduce significant differences in terms of liquidity, risk, and operational mechanics. Historically, these contracts evolved from simple agreements between farmers and merchants to lock in prices for future harvests, mitigating the risk of price fluctuations. Today, they're sophisticated instruments used globally across all major asset classes. Primary purposes. Market participants primarily use forward and futures contracts for two main reasons: hedging risk and speculation. Hedging risk. Hedging involves using a financial instrument to offset the risk of adverse price movements in an underlying asset. For businesses, this can mean protecting against unexpected increases in input costs or decreases in revenue from sales. Consider an airline that anticipates purchasing a large quantity of jet fuel in 3 months. The price of jet fuel, which is derived from crude oil, can be volatile. If the airline is concerned about fuel prices rising, it can use a futures contract to lock in a price today. Example: airline hedging fuel costs. An airline, Aerofleet, needs 100,000 barrels of jet fuel in 3 months. The current spot price is $80 per barrel, but Aerofleet is worried the price might rise. 1. Entering the futures contract, Aerofleet's Treasury Department decides to buy 100,000 barrels equivalent of crude oil futures contracts expiring in 3 months at a futures price of $82 per barrel. This is a long position. Conceptual flow. Aerofleet enters into an agreement today to buy 100,000 barrels of crude oil at $82/barrel in 3 months. 2. Scenario 1. Fuel prices rise. In 3 months, the spot price of jet fuel and crude oil rises to $95 per barrel. Aerofleet still needs to buy physical jet fuel at the current market price of $95/barrel, costing $9,500 100,000 barrels $95/barrel. However, the futures contract Aerofleet bought at $82/barrel is now worth $95/barrel. Aerofleet can sell its futures contracts at $95/barrel, realizing a profit of $13 per barrel, $95, $82 equals $13. Total profit from futures $1 300 100,000 barrels $13/barrel. Net cost for fuel $9 500 physical purchase $1 300 futures profit equals $8 200 This effectively locks in a price of $82/barrel, despite the spot price increase. 3. Scenario 2. Fuel prices fall. In 3 months, the spot price of jet fuel and crude oil falls to $70 per barrel. Aerofleet buys physical jet fuel at $70/barrel, costing $7 The futures contract Aerofleet bought at $82/barrel is now only worth $70/barrel. Aerofleet sells its futures contracts at $70/barrel incurring a loss of $12 per barrel, $82, $70 equals $12. Total loss from futures $1, 200, 100,000 barrels $12 barrel. Net cost for fuel $7, 000, physical purchase, plus $1, 200, futures loss, equals $8, 200, 000. Again, the effective price is $82 barrel, demonstrating how hedging stabilizes costs regardless of market fluctuations. This example illustrates how hedging helps businesses manage uncertainty and stabilize their financial planning. Speculation. Speculation involves taking a position in a financial instrument with the expectation of profiting from anticipated price movements. Speculators do not intend to take or make physical delivery of the underlying asset. Instead, they aim to profit from the difference between the buying and selling prices of the contract. Example: speculative futures trade. A trader, market mover, believes that the S/P 500 equity index will rise significantly in the next month due to positive economic forecasts. 1. Entering the futures contract. Market mover decides to buy one S/P 500 futures contract, a long position, for March delivery and index value of 5,000 points. The contract multiplier for the S/P 500 futures, E-mini, is $50 per index point, meaning the notional value of the contract is $250, 5,000 points $50/point. Conceptual flow. Market mover enters into an agreement today to buy the S/P 500 index at 5,000 points in March. 2. Scenario 1. Index rises. The S/P 500 index rises to 5,100 points before March. Market mover can sell their futures contract at 5,100 points, realizing a profit of 100 points. 5,100 minus 5,000 is equal to 100. Total profit $5, 100 points $50/point. 3. Scenario 2. Index falls. The S/P 500 index falls to 4,900 points before March. Market mover must sell their futures contract at 4,900 points or close out the position, incurring a loss of 100 points. 5,000 minus 4,900 is equal to 100. Total loss $5, 100 points $50/point. Speculators provide liquidity to the market and help in price discovery, but they also expose themselves to significant risk. Key differences between forwards and futures contracts. While both forwards and futures serve similar purposes, their structural and operational differences are critical. 1. Trading venue. OTC versus exchange traded. Forwards, traded over the counter, OTC. This means they are private, bilateral agreements negotiated directly between two parties, e.g., a bank and a corporate client. There is no centralized exchange. Futures, traded on organized exchanges, such as the Chicago Mercantile Exchange, CME, Intercontinental Exchange, ICE, or Eurex. The exchange acts as a central marketplace. 2. Customization versus standardization. Forwards, highly customized. Terms like the underlying asset, quantity, quality, delivery date, and settlement procedures can be tailored to the specific needs of the counterparties. This flexibility is a major advantage for unique hedging requirements. Futures, highly standardized. The exchange defines all contract specifications. Underlying asset, specific type and quality, e.g., West Texas Intermediate crude oil, 100 troy ounces of gold. Contract size, fixed quantity, e.g., 1,000 barrels of crude oil, 62,500 British pounds. Delivery dates, pre-specified monthly or quarterly cycles, e.g., March, June, September, December. Minimum price fluctuations, tick size the smallest allowed price movement. Settlement method, clearly defined as physical delivery or cash settlement. Standardization ensures that any buyer can trade with any seller without needing to agree on specific terms, facilitating easy trading. 3. Liquidity. Forwards, generally less liquid due to their customized nature. It can be challenging to find an opposite party willing to take over an existing forward contract, especially if its terms are high. GHLY specific. Closing out a forward typically requires negotiating with the original counterparty. Futures, generally highly liquid. Standardization and exchange trading create a deep market where there are always buyers and sellers. Positions can be easily entered or exited by simply taking an offsetting position on the exchange. 4. Counterparty risk. Counterparty risk is the risk that one party to a contract will fail to fulfill its obligations. Forwards, higher counterparty risk. Since forwards are private agreements, the solvency and creditworthiness of the counterparty are a direct concern. If one party defaults, the other party faces potential losses. Futures, significantly lower counterparty risk due to the role of the clearinghouse. For every futures trade, the clearinghouse effectively becomes the buyer to every seller and the seller to every buyer. This process, known as novation, guarantees the performance of the contract. The clearinghouse is typically a financially robust entity backed by its members' capital and strict risk management protocols. 5. Transparency. Forwards, less transparent. Prices and trading volumes are not publicly disclosed, as they are private transactions. This makes price discovery more challenging. Futures, highly transparent. All trades occur on an exchange, and prices, volumes, and open interest, the total number of outstanding contracts, are publicly disseminated in real time. This transparency contributes to efficient price discovery. 6. Margin requirements and daily settlement. Forwards, no daily settlement. The profit or loss is realized only at the contract's maturity date. There are typically no initial margin requirements, though collateral might be exchanged in some agreements. Futures contracts are mark-to-market daily. This means profits and losses are calculated and settled every trading day. To facilitate this, both parties are required to post margin. Initial margin, an upfront deposit required to open a futures position, ensuring the trader has sufficient funds to cover potential losses. This is not a down payment, but a performance bond. Maintenance margin, a minimum balance that must be maintained in the margin account. If the account balance falls below this level due to daily losses, a margin call is issued, requiring the trader to deposit additional funds to bring the account back to the initial margin level. Daily settlement and margin requirements significantly reduce the accumulation of large losses and mitigate counterparty risk. 7. Settlement method. Both forwards and futures can be settled in one of two ways. Physical delivery. The actual underlying asset is delivered from the seller to the buyer on the expiry date. This is common for commodity futures, e.g., crude oil, agricultural products. Cash settlement. No physical asset changes hands. Instead, the difference between the contract price and the market price at expiry is settled in cash. This is common for financial futures where physical delivery is impractical or undesirable, e.g., equity index futures, interest rate futures, some currency futures. The method of settlement is a predefined term within the contract specification. Comparative summary table. Feature forward contract, futures contract. Trading venue over the counter, OTC, organized exchange. Customization, highly customized, standardized, fixed size, quality, dates. Liquidity, lower, higher. Counterparty risk, higher, bilateral, lower, guaranteed by clearinghouse. Transparency, less transparent, private. Highly transparent, public prices, volumes. Regulation, less regulated, highly regulated. Margin/settlement, no daily marking to market. Settlement at expiry, daily marking to market. Margin requirements. Default risk, significant, minimized by clearinghouse and daily margin calls. Typical users: corporates, financial institutions, speculators, hedgers, institutional investors. Underlying assets: any, commodities, currencies, interest rates, any, commodities, currencies, interest rates, equities. Understanding these distinctions is crucial for anyone engaging with derivatives, whether for hedging, speculation, or developing quantitative trading strategies. The standardization and robust infrastructure of future ES markets make them particularly suitable for algorithmic trading and large-scale financial operations, which will be explored in subsequent sections. Understanding derivatives. An introduction. Financial derivatives are contracts whose value is derived from an underlying asset, index, or rate. They are powerful tools used in quantitative trading for a variety of purposes, including hedging existing risks, speculating on future price movements, and exploiting arbitrage opportunities. Among the most fundamental types of derivatives are forward and futures contracts, which form the bedrock for understanding more complex instruments like options and swaps. Forward contracts. A forward contract is a customized agreement between two parties to buy or sell an asset at a specified price on a future date. These contracts are privately negotiated and traded over the counter, OTC, meaning they are not traded on a centralized exchange. Key characteristics of forward contracts. Customization. Forwards are highly flexible. The terms, including the underlying asset, quantity, delivery date, and price, can be tailored precisely to the needs of the two parties involved. For instance, a farmer might agree to sell a specific quantity of wheat to a baker on a particular date at a predetermined price. Over-the-counter, OTC, trading. Forward contracts are private agreements. They are not standardized and do not trade on organized exchanges. This allows for bespoke agreements, but also introduces certain risks. Counterparty risk. Since there is no central clearing entity, both parties in a forward contract are exposed to the risk that their party might default on their obligation. This is known as counterparty risk. If the farmer defaults, the baker might not receive the agreed-upon wheat. If the baker defaults, the farmer might not receive payment. Settlement. Forward contracts typically involve physical delivery of the underlying asset at the contract's expiry. However, some forward contracts may be cash settled, where only the net difference in value is exchanged. No mark-to-market. Unlike futures, forward contracts are generally not marked to market daily. The full profit or loss is realized only at the contract's maturity. Purpose of forward contracts. Forward contracts are primarily used for hedging. This is the most common use. A party facing a future price risk can lock in a price today. For example, an airline might use a forward contract to lock in the price of jet fuel for future consumption, protecting itself from potential price increases. Conversely, an oil producer might sell oil forward to guarantee a selling price, protecting against price drops. Speculation. While less common due to liquidity constraints, a party can speculate on future price movements by entering a forward contract if they believe the future spot price will be different from the forward price. Example. Hedging with a forward contract. Consider a farmer who expects to harvest 10,000 bushels of wheat in 3 months. The current spot price is $6.00 per bushel, but the farmer is concerned the price might fall. A buck needs 10,000 bushels of wheat in 3 months and is concerned the price might rise. They can enter into a forward contract today. Underlying asset, wheat. Quantity, 10,000 bushels. Delivery date, in 3 months. Forward price $6.10 per bushel, negotiated. Scenario 1. Wheat price drops to $5.50 at delivery. Farmer's outcome. Sells at $6.10, avoiding a loss of $6.10, $5.50. 10,000 equals $6.00 had they sold at spot. Baker's outcome. Pays $6.10, but would have paid $5.50 at spot. The baker effectively paid an extra $0.60 per bushel, or $6.00 for price certainty. Scenario 2. Wheat price rises to $6.50 at delivery. Farmer's outcome. Sells at $6.10, missing out on a profit of $6.50, $6.10. 10,000 equals $4,000 had they sold at spot. Baker's outcome. Pays $6.10, saving $6.50, $6.10. 10,000 equals $4,000 compared to buying at spot. In both scenarios, the forward contract locks in the price, eliminating price uncertainty, but also foregoing potential gains from favorable price movements. Limitations of forward contracts. The customized nature and OTC trading environment of forward contracts lead to several limitations. Illiquidity. It can be difficult to find a counterparty willing to take the opposite side of a highly specific contract. Even if found, exiting the contract before maturity often requires mutual agreement with the original counterparty or finding a new counterparty, which is challenging. High counterparty risk. As discussed, the risk of default, LT by either party, is a significant concern. Price discovery. Due to their private nature, forward prices are less transparent than exchange-traded prices. When a party wishes to extend their exposure in a forward contract beyond its original maturity, they typically enter into a new forward contract with a later expiry date, effectively rolling forward their position. This requires negotiating an entirely new agreement with a counterparty. Futures contracts. A futures contract is a standardized agreement between two parties to buy or sell a specified asset of standardized quantity and quality at a specified price on a future date. Unlike forwards, futures contracts are traded on organized exchanges. Key characteristics of futures contracts. Standardization. Futures contracts have predefined terms. The underlying asset, quantity, quality, and delivery dates are all standardized by the exchange. For example, a crude oil futures contract, e.g., WTI crude on NYMEX, specifies 1,000 barrels of light sweet crude oil. An S&P 500 E-mini futures contract represents $50 times the S&P 500 index. This standardization allows for active trading. Exchange-traded. Futures contracts are traded on regulated exchanges, e.g., CME Group, ICE Futures. This provides transparency, liquidity, and a centralized marketplace. Clearinghouse guarantee. A crucial feature of futures markets is the presence of a clearinghouse. The clearinghouse acts as the buyer to every seller and the seller to every buyer. This effectively eliminates counterparty risk for individual traders, as their counterparty is always the financially sound clearinghouse. Margin requirements. To ensure that traders can meet their obligations, futures contracts require participants to deposit an initial sum of money, known as initial margin, into a margin account. As prices fluctuate, profits and losses are settled daily, and traders may be required to deposit additional funds, maintenance margin and variation margin, if their account balance falls below a certain threshold. This daily settlement process is called mark-to-market. Daily mark-to-market. At the end of each trading day, all futures positions are marked to market. This means that the profits and losses on open positions are calculated based on the day's closing price and are immediately credited or debited to the trader's margin accounts. This daily cash flow reduces the accumulation of large losses and helps manage risk. Liquidity. Due to standardization and exchange trading, futures markets are typically highly liquid, allowing traders to easily enter and exit positions. Settlement. Most futures contracts are cash settled, meaning that at expiry, only the net financial difference between the contract price and the underlying asset spot price is exchanged. Some commodity futures, however, do allow for physical delivery. Purpose of futures contracts. Like forwards, futures are used for hedging. Companies and individuals futures to hedge against adverse price movements in commodities, currencies, interest rates, or stock indices. For example, a portfolio manager might sell S&P 500 E-mini futures to hedge a diversified equity portfolio against a potential market downturn. If the market falls, the loss on the stock portfolio is offset by the profit on the short futures position. Speculation. Traders often use futures to speculate on the future direction of prices. Their high leverage, due to margin, can amplify both gains and losses. Arbitrage. Differences in pricing between the spot market and the futures market, or between different futures contracts, can create arbitrage opportunities for sophisticated traders. Specific examples of contract sizes. To illustrate the concept of standardization. Crude oil futures, WTI, traded on NYMEX, CME Group. One contract typically represents 1,000 barrels of West Texas Intermediate, WTI, crude oil. Price movements are quoted in increments of $0.01 per barrel, meaning each tick change is worth $10. 1,000 barrels $0.01/barrel. S&P 500 E-mini futures, traded on CME. One contract represents $50 multiplied by the S&P 500 index. Price movements are quoted in quarter-point increments, 0.25 index points, meaning each tick change is worth $12.50, $50 0.25. Euro FX futures, traded on CME. One contract represents 125,000 euros. Price movements are quoted in increments of $0.00005 per euro, meaning each tick change is worth $6.25, 125,000 0.00005. These small, standardized increments facilitate precise position, sizing, and efficient trading. The role of the clearinghouse. The clearinghouse is a central entity in the futures market that plays a critical role in ensuring the integrity and stability of trades. It acts as an intermediary for all transactions, effectively becoming the counterparty to every buyer and seller. Guaranteeing trades. When a buyer and seller agree on a futures price, they don't transact directly with each other. Instead, the clearinghouse steps in. The buyer's contract is with the clearinghouse, and the seller's contract is also with the clearinghouse. This process, known as novation, means that the clearinghouse guarantees the performance of both sides of the contract. This virtually eliminates counterparty risk for individual market participants. Risk management through margin accounts. The primary mechanism by which the clearinghouse manages its risk, and thus the risk for all participants, is through margin requirements and the daily mark-to-market process. Initial margin. This is the amount of money that a trader must deposit into their margin account before they can open a futures position. It acts as a performance bond, ensuring the trader has sufficient funds to cover potential daily losses. The amount is set by the clearinghouse and varies based on the volatility of the underlying asset. Maintenance margin. This is the minimum amount that must be maintained in the margin account. T at all times. If the account balance falls below the maintenance margin level due to adverse price movements, the trader receives a margin call. Margin call. A margin call is a demand from the clearinghouse or broker for the trader to deposit additional funds, variation margin, to bring their account balance back up to the initial margin level. If the trader fails to meet the margin call, their position may be liquidated. This daily settlement and margin system ensures that losses are covered promptly, preventing large defaults that could destabilize the market. The clearinghouse protects itself and other market participants from a specific trader's potential default, not directly from the price movement of the underlying asset itself. Exchange profit versus bid-ask spread. It's important to distinguish between how exchanges profit and the concept of the bid-ask spread. Exchange profits. Futures exchanges generate revenue, primarily through trading fees and clearing fees. These are charged per contract traded or per side of a trade. They also profit from data sales and listing fees. Bid-ask spread. The bid-ask spread is the difference between the highest price a buyer is willing to pay, bid, and the lowest price a seller is willing to accept, ask. This spread is typically maintained by market makers, who profit by facilitating trades and capturing this difference. While the spread affects the cost of trading for participants, it is not a direct source of profit for the exchange itself, but rather for liquidity providers. Key differences: forward versus futures contracts. While both forward and futures contracts serve similar purposes, hedging and speculation, Their structural differences are significant for market participants. Feature forward contract, futures contract. Standardization, customized, terms negotiated by parties, standardized, quantity, quality, delivery by exchange. Trading venue over the counter, OTC, private agreement organized exchanges, e.g., CME, ICE. Counterparty risk high, exposure to default by specific counterparty, low, clearinghouse guarantees trades. Liquidity low, difficult to exit or find counterparties, high, easy to enter and exit positions. Regulation less regulated, bilateral agreements. Highly regulated, exchange rules, government oversight. Price transparency low, private quotes. High, publicly quoted exchange prices. Margin/mark-to-market, generally no daily margin calls or mark-to-market daily mark-to-market and margin requirements. Settlement, typically physical delivery or cash settlement at expiry, usually cash settlement, offsetting position. Some physical delivery options. Flexibility high due to customization, low due to standardization. Price discovery, less efficient, more efficient. Liquidity implications. The difference in liquidity is a critical practical implication. Forwards, due to their customized nature and OTC trading, finding a counterparty willing to take the opposite side of a specific forward contract can be challenging. If a party wants to exit a forward contract before its maturity, they typically need to negotiate with their original counterparty or find a new one to take over the existing contract, which is often difficult and costly. This makes forwards less suitable for speculative trading where frequent entry and exit are desired. Futures. The standardization and centralized exchange trading of futures lead to high liquidity. A trader can easily offset an existing position by taking an opposite trade on the exchange. For example, a trader who is long 10 futures contracts can simply sell 10 identical contracts to close their position. The clearinghouse handles the netting of these positions, and the original counterparty is irrelevant. This ease of entry and exit makes futures highly attractive for both hedging and speculation. Profit and loss mechanics for futures contracts. Understanding how profits and losses accrue in futures contracts is fundamental. The P/L is determined by the difference between the contract's entry price and its exit price, or settlement price at expiry. Long position buyer. A trader takes a long position when they buy a futures contract, expecting the price of the underlying asset to increase. Profit I. If the futures price at expiry, or when the position is closed, is higher than the entry price. Loss. If the futures price at expiry, or when the position is closed, is lower than the entry price. Short position, seller. A trader takes a short position when they sell a futures contract, expecting the price of the underlying asset to decrease. Profit. If the futures price at expiry, or when the position is closed, is lower than the entry price. Loss. If the futures price at expiry, or when the position is closed, is higher than the entry price. Numerical example, profit/loss calculation for a futures position. Let's use an example of crude oil, WTI, futures. One contract is for 1,000 barrels. Scenario. A speculator goes long 1 WTI crude oil futures contract at $75.00 per barrel, expecting oil prices to rise. The contract expires in 1 month. Case 1. Oil price rises at expiry. Suppose the WTI spot price at expiry, which determines the final settlement price for the futures contract, is $80.00 per barrel. Entry price $75.00/barrel. Expiry price $80.00/barrel. Price difference $80.00/$75.00 equals $5.00/barrel. Total profit $5.00/barrel 1,000 barrels contract equals $5,000. The speculator makes a profit of $5,000. This profit would have been accrued daily via the mark-to-market process. Case 2. Oil price falls at expiry. Suppose the WTI spot price at expiry is $70.00 per barrel. Entry price $75.00/barrel. Expiry price $70.00/barrel. Price difference $$70.00/$75.00 equals $5.00/barrel. Total loss $$5.00/barrel 1,000 barrels/contract equals $$5,000. The speculator incurs a loss of $5,000. This loss would have been debited daily from their margin account. If the loss exceeded their maintenance margin, they would have faced margin calls. Numerical example: cash settlement for futures contracts. Most futures contracts are cash settled. This means that at expiry, there is no physical delivery of the underlying asset. Instead, the financial difference between the contract price and the final settlement price is exchanged. Scenario: an investor holds a long position in one S&P 500 E-mini futures contract, bought at an index level of 4,000. One E-mini contract is valued at $50 per index point. At expiry, suppose the S&P 500 index, the underlying, settles at 4,050. Contract price for 1,000 index points. Final settlement price 4,050 index points. Index point difference 4,050 minus 4,000 is equal to 50 index points. Value per index point $50. Cash settlement amount: profit 50 index points $50 / index point equals $2 500. Since the investor was long and the price increased, they receive $2 500 in cash. Conversely, if the index had settled at 3,950, they would owe $50 3,950 to 4,000 equals $2 500. This cash settlement mechanism makes futures very efficient for financial instruments and indices, as it avoids the complexities and costs associated with physical delivery. For traders wishing to maintain exposure, they would simply enter a new futures co. Tracked with a later expiry date. The rolling forward concept applies here too, but it's simpler in futures due to liquidity, as you just offset your old position and open a new one. Practical applications of futures contracts. Futures contracts are integral to modern financial markets, serving diverse needs for various market participants. Hedging against market risk. Futures are widely used by institutional investors and corporations to mitigate price risk. Scenario: portfolio manager hedging a stock portfolio. A portfolio manager oversees a diversified stock portfolio valued at $100 million, which closely tracks the performance of the S&P 500 index. The manager is concerned about a potential short-term market downturn, but does not want to sell individual stocks due to transaction costs or tax implications. Strategy: the manager can sell S&P 500 E-mini futures contracts. Calculation: each E-mini contract is valued at $50 per index point. If the S&P 500 is currently at 4,000, one contract is worth 4,000 $50 equals $200,000. To hedge $100 million, the manager needs to sell a number of contracts approximately equal to $100,000 $200,000 per contract equals 500 contracts. Outcome: if the S&P 500 index falls by 10%, e.g., from 4,000 to 3,600, the stock portfolio might lose approximately $10 million. However, the short futures position would generate a profit. Price difference per index point: 4,000 minus 3,600 is equal to 400 points. Profit per contract: 400 points $50 / point equals $20 Total profit from futures, 500 contracts $20, 000 slash contract equals $10, 000. This profit from the futures position would largely offset the loss from the stock portfolio, effectively protecting the portfolio's value during the downturn. Speculation. Speculators use futures to profit from anticipated price movements. They are willing to take on price risk in exchange for potential returns. This often involves significant leverage, as only a small margin deposit is required to control a large notional value of the underlying asset. Arbitrage. Arbitrageurs seek to profit from temporary price discrepancies between the futures market and the spot market, or between different futures contracts. For example, if the theoretical futures price, based on the cost of carry model, differs significantly from the actual futures price, an arbitrageur might buy the undervalued asset/contract and sell the overvalued one to lock in a risk-free profit. Lot size. Every standardized futures contract specifies a precise quantity of the underlying asset that must be delivered or settled per contract. This fixed quantity is known as the lot size or contract multiplier. It ensures uniformity and liquidity, allowing traders to buy or sell contracts without needing to negotiate the exact amount of the underlying asset for each transaction. For example, a crude oil futures contract on the New York Mercantile Exchange, NYMEX, typically has a lot size of 1,000 barrels. This means that one futures contract represents an obligation to deliver or receive 1,000 barrels of crude oil. Similarly, an E-mini S&P 500 futures contract, ES, represents $50 times the S&P 500 index level. The lot size is a critical parameter because it directly determines the total exposure and potential profit or loss from a single contract. It's often embedded within the contract's ticker symbol or readily available in the contract specifications provided by exchanges and brokers. Consider the ticker symbol code snippet. Code snippet indicates the E-mini S&P 500 futures. Code snippet denotes the December expiration month. Code snippet signifies the year 2023. For this code snippet contract, the lot size or contract multiplier is $50. This is a fixed value defined by the exchange. Contract value, notional value. The contract value, also known as the notional value, represents the total monetary value of the underlying asset controlled by one futures contract. Is calculated by multiplying the current futures price by the contract's lot size. It is crucial to understand that the current market price used in this calculation refers specifically to the futures price of the contract itself, not necessarily the spot price of the underlying asset. Futures contracts trade independently with their own supply and demand dynamics, and thus have their own price distinct from the spot market. The contract value is dynamic, changing constantly with fluctuations in the futures price. As the futures price moves up or down, the total notional value of the position changes accordingly. This value is distinct from the actual capital required to enter a position, which is significantly lower due to the leverage inherent in futures trading, discussed in the next section on margin. Let's illustrate this with an example and a simple code snippet. Suppose an E-mini S&P 500 futures contract, ES, is trading at a price of $4,500. The lot size for ES contracts is $50 per index point. The notional contract value would be code snippet. Code snippet. This means that one E-mini S&P 500 futures contract controls $225,000 worth of S&P 500 index exposure. We can create a simple Python function to calculate the notional contract value. Download the code on OnePageCode Substack. This function code snippet takes the code snippet and code snippet as inputs and returns their product, representing the total notional exposure of one contract. Let's use this function with an example. Download the code on OnePageCode Substack. Running the above code will output the calculated notional values for both the E-mini S&P 500 and crude oil futures contracts, demonstrating how the same function can be used for different instruments given their specific parameters. This highlights the substantial leverage in futures, A trader only needs to post a fraction of this notional value as margin to control a large underlying position. Margin requirements. Unlike traditional stock trading, where you pay the full value of the shares or a significant portion for margin trading, futures trading requires only a small percentage of the contract's notional value to be deposited as a margin. This margin acts as a performance bond or a good faith deposit, ensuring that traders can cover potential losses. It is not a down payment on the asset itself. The use of margin is what makes futures contracts highly leveraged instruments. A small capital outlay can control a large notional value, amplifying both potential profits and losses. There are two primary types of margin in futures trading. 1. Initial margin. This is the amount of capital required in your trading account to open a new futures position. It is set by the exchange or clearinghouse and varies based on the volatility of the underlying asset and the contract's notional value. 2. Maintenance margin. Once a position is open, the account balance must remain above this level. The maintenance CE margin is typically a lower amount than the initial margin. Its purpose is to ensure that there is enough capital to cover potential daily losses. Margin calls and their implications. When the equity in your futures account falls below the maintenance margin level, you will receive a margin call. A margin call is a demand from your broker to deposit additional funds into your account to bring your equity back up to the initial margin level. If you fail to meet a margin call within the specified time frame, often by the next trading day, your broker has the right to liquidate your positions to cover the deficit, regardless of your consent or the market conditions. This can result in significant losses and is a critical risk for futures traders. Let's simulate a margin account and a margin call scenario using Python. First, we define some initial parameters for a hypothetical futures contract and account. Download the code on OnePageCode Substack. These variables set up our scenario: 1ES contract, initial balance, and margin requirements. Next, we calculate the required margin to open the position and the initial account status. Download the code on OnePageCode Substack. This segment checks if the account has enough funds to open the position. If so, it simulates the initial state, showing the margin held and the remaining free equity. The code snippet variable will be updated as the futures price changes, reflecting profits or losses. Now, let's simulate price M. Movements and check for a margin call. Download the code on OnePageCode Substack. The code snippet function calculates the unrealized profit or loss, P&L, based on the price movement. It then determines the code snippet by adding this P&L to the initial account balance. If this code snippet falls below the code snippet, a margin call is triggered, and the function calculates the amount needed to bring the account back to the code snippet level. Let's simulate a price drop and observe the margin call. Download the code on OnePageCode Substack. This simulation demonstrates how a drop in the futures price can lead to a margin call. The first scenario shows a small price drop that keeps the equity above the maintenance margin. The second scenario shows a larger drop that pushes the effective equity below the maintenance margin, triggering the call and specifying the amount required. This direct financial implication highlights the importance of managing leverage and monitoring positions closely. Expiration date. Every futures contract has a specified expiration date, also known as the last trading day or delivery date. This is the final day on which the contract can be traded. After this date, the contract is settled and all open positions are closed. The expiration date is crucial for several reasons. 1. Settlement. On or around the expiration date, the contract will undergo settlement. This can be either physical settlement, the underlying asset, e.g. barrels of oil, b. bushels of corn, gold bars, is physically delivered from the seller to the buyer. This is common for commodity futures. Cash settlement. The contract is settled by a cash payment reflecting the difference between the final settlement price and the contract's entry price. No physical asset changes hands. This is common for index futures, like the S&P 500, or interest rate futures, where physical delivery is impractical or impossible. The implications of physical versus cash settlement are significant. Traders who do not intend to take or make physical delivery must close their positions before the last trading day to avoid this obligation. 2. Price convergence. As a futures contract approaches its expiration date, its price typically converges with the spot price of the underlying asset. This convergence happens because the costs of carrying the asset, storage, interest, insurance, diminish as delivery approaches and arbitrage opportunities become more pronounced. 3. Contract series. Futures contracts are typically available in a series of expiration months, e.g., March, June, September, December. This allows traders to choose contracts that align with their specific hedging or speculative time horizons. Rolling over a futures position. For traders who wish to maintain their exposure to an underlying asset beyond the current contract's expiration date, a common practice is to roll over the position. Rolling over involves simultaneously closing the expiring futures contract and opening a new position in a futures contract with a later expiration date. The primary reasons for rolling over are to avoid physical delivery or cash settlement of the expiring contract, to maintain continuous exposure to the underlying market without interruption. This process involves two distinct transactions, often executed as a spread or roll trade to minimize execution risk. 1. Sell to close the expiring contract. 2. Buy to open the next available contract month or a later month. The difference in price between the expiring contract and the new contract is known as the roll cost or roll yield, which can be positive or negative depending on the market's contango, later months more expensive, or backwardation, later months cheaper, structure. Let's illustrate the concept of rolling over with a simple code example. We'll define a function that simulates this process. Download the code on OnePageCode Substack. This function code snippet simulates the two-step process. It calculates the P&L from closing the old contract and then notes the price of a new contract. It also highlights the roll cost, which is the price difference between the two contracts. Let's run a scenario. Download the code on OnePageCode Substack. In this scenario, we assume the expiring contract is trading at 4,500.0 and the next month's contract is trading at 4,510.0. The code snippet function calculates the P&L from the expiring contract, assuming an initial entry price of 4,450.0 for that contract, and then shows the cost of rolling into the new contract. This demonstrates how a trader maintains continuous market exposure by transitioning from one contract month to the next. Collective impact and real-world context. The parameters of a futures contract, lot size, contract value, margin requirements, and expiration date, collectively define its structure, risk profile, and trading mechanics. For a quantitative trader or developer, understanding these parameters is not merely theoretical. It's fundamental too. Trade sizing, determining how many contracts to trade based on desired exposure and risk tolerance. Risk management, calculating potential profit/loss, exposure, and capital at risk. Capital allocation, understanding initial and ongoing capital requirements. Data parsing, extracting relevant information from exchange, APIs, or data feeds, where these parameters are often embedded or provided in specifications. Strategy implementation, designing algorithms that correctly account for leverage, margin calls, and contract rollovers. On actual futures exchanges or broker platforms, these parameters are prominently displayed in the contract specifications. For example, a typical contract specification page might list symbol, code snippet, description, E-mini S&P 500 futures, December 2023. Exchange, CME. Contract size / multiplier, $50 x S&P 500 index. Minimum tick, 0.25 index points equals $12.50. Initial margin, $15,000 example. Maintenance marg, in $12,000 example. Last trading day, December 15th, 2023 example. Settlement method, cash settled. Familiarity with these details is paramount for anyone engaging with futures markets, whether manually or programmatically. Hedging and speculation. Futures and forward contracts serve two primary, yet distinct, purposes in financial markets: hedging and speculation. Understanding these two motivations is fundamental to grasping the practical utility of derivatives. Understanding hedging. Hedging is a risk management strategy employed to offset the risk of adverse price movements in an asset, commodity, or currency. The core motivation behind hedging is risk mitigation, not profit maximization. A hedger typically has an existing or anticipated exposure to a price risk in the spot market and uses a futures contract to lock in a price or reduce the variability of a future cash flow. Motivation behind hedging. Businesses and individuals face various price risks. Producers, e.g., farmers, miners, are exposed to falling prices for their output. Consumers, e.g., airlines, manufacturers, are exposed to rising prices for their inputs. Financial institutions are exposed to interest rate fluctuations or currency rate changes. By taking an opposing position in the futures market to their existing or anticipated spot market exposure, hedgers aim to stabilize their revenues or costs. Types of hedging. 1. Short hedge, selling futures used by those who own an asset or anticipate selling an asset in the future. They sell futures contracts to protect against a decline in the asset's price. 2. Long hedge, buying futures used by those who anticipate buying an asset in the future. They buy futures contracts to protect against an increase in the asset's price. Detailed example. Farmer hedging wheat prices, short hedge. Consider a farmer who expects to harvest 10,000 bushels of wheat in 3 months. The current spot price for wheat is $5.00 per bushel, and the 3-month wheat futures contract is trading at $5.10 per bushel. The farmer is concerned that the price of wheat might fall before harvest, reducing their revenue. To hedge this risk, the farmer can sell wheat futures contracts today. If one futures contract represents 5,000 bushels, the farmer would sell 2 contracts, 10,000 bushels / 5,000 bushels / contract. Let's illustrate the outcome under 2 scenarios for the future spot price, comparing the hedged versus unhedged position. Scenario 1. Wheat price falls. Suppose in 3 months, the spot price of wheat falls to $4.50 per bushel. The futures price will also converge to the spot price. So the futures contract the farmer sold at $5.10 will now be worth $4.50. Unhedged position. The farmer sells 10,000 bushels at $4.50 / bushel equals $45,000. Hedge position. Revenue from selling wheat in spot market. 10,000 bushels $4.50 / bushel equals $45,000. Profit from futures contract. Selling price, buying back price, quantity equals $5.10, $4.50, 10,000 equals $0.60, 10,000 equals $6,000. Net revenue $45,000 spot plus $6,000 futures equals $51,000. The net effective price per bushel for the hedge farmer is $51,000 / 10,000 bushels equals $5.10 per bushel, effectively locking in the futures price. Scenario 2. Wheat price rises. Suppose in 3 months, the spot price of wheat rises to $5.50 per bushel. The futures price will also converge to the spot price. So the futures contract the farmer sold at $5.10 will now be worth $5.50. Unhedged position. The farmer sells 10,000 bushels at $5.50 / bushel equals $55,000. Hedge position. Revenue from selling wheat in spot market. 10,000 bushels $5.50 / bushel equals $55,000. Loss from futures contract. Selling price, buying back price, quantity equals $5.10, backslash $5.50. 10,000 equals dash backslash $0.40. 10,000 equals dash backslash $4,000. Net revenue backslash $55,000 spot backslash $4,000 futures equals backslash $51,000. Again, the net effective price per bushel for the hedge farmer is backslash $51,000 slash 10,000 bushels equals backslash $5.10 per bushel. As demonstrated, hedging reduced the variability of the farmer's revenue, effectively locking in a price close to the initial futures price, regardless of whether the spot price moved up or down. Code example: simulating hedging effectiveness for a farmer. We can simulate this using Python to visualize the P&L for both hedged and unhedged scenarios. First, let's define our parameters for the farmer scenario. Download the code on OnePageCode Substack. Here, we set up the core financial parameters. Code snippet is the current market price. Code snippet is the price locked in by the farmer via the futures market. And code snippet is the quantity of the commodity the farmer needs to sell. Next, we'll create a function to calculate the profit, T or loss, P&L, for both the unhedged and hedged positions given a future spot price. Download the code on OnePageCode Substack. This function code snippet is the core of our simulation. It takes a code snippet as input, which represents the actual price of wheat at the time of harvest. It then calculates the revenue if the farmer had not hedged, code snippet, and the combined revenue, code snippet, from selling the wheat in the spot market and closing out the futures position. Notice how the futures P&L offsets the spot market fluctuation. Finally, we'll run the simulation for various potential future spot prices and print the results to demonstrate the effect of hedging. Download the code on OnePageCode Substack. The output clearly shows that while the code snippet fluctuates significantly with the future spot price, the code snippet remains constant at backslash $51,000, which is the code snippet multiplied by code snippet. This constancy demonstrates the effectiveness of hedging in locking in a price. Common pitfalls and best practices in hedging. Basis risk. The most significant risk in hedging is code snippet. Basis is the difference between the spot price of an asset and its futures price, code snippet. Basis is not constant and can fluctuate due to supply/demand imbalances, storage costs, interest rates, and other market factors. If the basis changes unexpectedly between the time the hedge is placed and when it is lifted, the hedge may not perfectly offset the spot mark. T exposure, leading to code snippet. Overhedging/underhedging. If the quantity hedged is not precisely equal to the quantity of the underlying exposure, the hedge will be imperfect. This can happen due to uncertainty about future production, e.g., crop yield or consumption. Liquidity risk. For liquid futures contracts, it might be difficult to enter or exit positions at favorable prices. Counterparty risk. While less common in exchange-traded futures due to clearinghouses, it is a concern for over-the-counter, OTC, forward contracts. Best practices include carefully matching the futures contract to the underlying exposure, understanding basis dynamics, and regularly monitoring and adjusting the hedge as market conditions or exposure changes. Understanding speculation. Speculation is the act of engaging in financial transactions that involve substantial risk in the hope of generating significant profit from anticipated price movements. The primary motivation for a speculator is profit-seeking, unlike a hedger who seeks risk mitigation. Speculators do not necessarily have an existing exposure in the underlying asset. Instead, they take a view on the future direction of prices. Characteristics of speculators. High-risk appetite. Speculators are willing to take on considerable risk in pursuit of substantial returns. Market view. They form opinions on whether prices will rise or fall and take positions accordingly. Analytical approach. Speculators often employ technique, cal analysis, fundamental analysis, or quantitative models to predict market movements. Leverage. Futures contracts inherently involve leverage, meaning a small capital outlay. Margin can control a large value of the underlying asset. This amplifies both potential gains and losses. Detailed example. Traders speculating on oil prices. Imagine a trader who believes that global economic recovery will drive up demand for crude oil, leading to an increase in oil prices. The current price of a crude oil futures contract, representing 1,000 barrels, for delivery in 3 months is $70 per barrel. The trader decides to buy one crude oil futures contract. Scenario 1. Oil price rises. Trader is correct. Suppose in 1 month, the price of the crude oil futures contract rises to $75 per barrel. The trader decides to close out their position by selling the contract. Profit on futures contract. Selling price, buying price, contract size equals $75, $70. 1,000 barrels equals $5, 1,000 equals $5, 000 profit. Scenario 2. Oil price falls. Trader is incorrect. Suppose in 1 month, the price of the crude oil futures contract falls to $65 per barrel. The trader decides to cut their losses and sell the contract. Loss on futures contract. Selling price, buying price, contract size equals $65, $70. 1,000 barrels equals $5, 1,000 equals $5, 000 loss. In both scenarios, the trader's profit or loss is directly proportional to the price movement and the contract size. Code example. Simulating a speculate. eBay trade P&L. Let's simulate a simple speculative trade on a futures contract. First, define the trade parameters. Download the code on OnePageCode Substack. Here, code snippet defines the multiplier for the price change, and code snippet is the entry point for the speculator's position. Next, a function to calculate the P&L for a speculative trade. Download the code on OnePageCode Substack. This function code snippet takes the code snippet, the exit price, and code snippet, entry price, along with contract details. It accounts for both long, betting on price increase, and short, betting on price decrease positions. Finally, we'll run the simulation for different potential outcomes. Download the code on OnePageCode Substack. The simulation clearly shows how the P&L for a speculative long position moves directly with the final price. A higher final price results in profit, while a lower final price results in a loss. Risks associated with speculation. Leverage. While leverage amplifies gains, it also amplifies losses. A small adverse price movement can lead to significant losses, potentially exceeding the initial margin deposit. Unlimited loss potential. In some cases, e.g., a short position in a rapidly rising market, theoretical losses can be unlimited. However, in practice, brokers will issue margin calls, forcing the speculator to deposit more funds or liquidate the position. Volatility. Speculators thrive on volatility, but extreme volatility can lead to rapid and unpredictable price swings, making it difficult to manage positions. Market risk. The risk that the overall market moves against the speculator's position due to unforeseen events. Economic functions of speculators. Beyond simply seeking profit, speculators play vital roles in financial markets. 1. Liquidity provision. Speculators are crucial for market liquidity. By being willing to buy or sell at various price levels, they ensure that there are always willing counterparties for hedgers or other market participants. Without speculators, hedgers might struggle to find someone to take the other side of their risk-transferring trade. 2. Price discovery. Speculators, through their active trading based on their assessment of future supply and demand, contribute to the efficient formation of prices. Their collective actions incorporate new information into futures prices, making them a good forecast of future spot prices. 3. Risk transfer. Speculators willingly take on the price risk that hedgers wish to offload. They assume this risk in the hope of profiting from it, thereby facilitating the risk transfer mechanism essential for hedgers. 4. Market efficiency. By acting on new information quickly, speculators help markets reflect all available information, leading to more efficient pricing and reducing opportunities for arbitrage. The symbiotic relationship. Hedgers and speculators. Hedgers and speculators, despite their differing motivations, are highly interdependent. They form a symbiotic relationship that is crucial for the efficient functioning of futures markets. Hedgers need speculators. Hedgers want to transfer their price risk. To do this, they need someone willing to take on that risk. Speculators fill this role, providing the necessary counterparty to the hedger's trade. For example, when a farmer sells wheat futures to hedge against falling prices, a speculator might buy those contracts, believing prices will rise. Speculators need hedgers. Speculators need liquidity and opportunities to take positions based on their market views. Hedgers provide this by constantly entering the market to manage their exposures, creating a continuous flow of buy and sell orders that speculators can capitalize on. This interaction ensures that risk can be efficiently transferred from those who wish to avoid it, hedgers, to those who are willing to assume it in exchange for potential profit, speculators. Comparison: hedgers versus speculators. The table below summarizes the key differences between hedgers and speculators. Feature hedgers, speculators. Primary goal: risk mitigation / reduction, profit maximization. Motivation: protect against adverse price movements, capitalize on anticipated price movements. Existing risk: yes. Existing or anticipated spot exposure: no. Create a new risk position. Position off. Set an existing spot position, take a directional view on price. Risk appetite: low, risk averse. High risk seeking. Focus: stability of future cash flows / costs, absolute profit / loss. Impact on market: transfer risk, reduce volatility for self, provide liquidity, contribute to price discovery, assume risk. Typical instruments: futures, forwards, options, futures, options, stocks, forex, etc. Obligations at maturity. When a futures contract reaches its expiration date, known as its maturity, the parties involved are obligated to fulfill the terms of the agreement. This fulfillment primarily takes one of two forms: physical delivery or cash settlement. While these are the ultimate obligations, it's crucial to understand that the vast majority of futures contracts do not proceed to actual settlement. Instead, they're closed out through offsetting transactions before maturity. Physical delivery. Physical delivery involves the actual exchange of the underlying asset between the long, buyer, and short, seller, parties of the futures contract. This means the seller delivers the specified quantity and quality of the commodity, and the buyer pays the agreed-upon futures price. Typical assets for physical delivery. This settlement method is common for tangible commodities where actual possession is practical and often desired by market participants, especially commercial entities. Agricultural commodities: corn, wheat, soybeans, live cattle. Energy products: crude oil, natural gas, heating oil. Metals: gold, silver, copper. Logistical complexities and costs. Physical delivery is often a complex logistical undertaking, which is a primary reason why most speculative traders avoid it. Storage: the seller must deliver the commodity to an approved exchange-designated warehouse or delivery point. The buyer must then arrange for its storage. Transportation: moving large quantities of commodities incurs significant transportation costs. Quality inspection: ensuring the delivered commodity meets the contract's specified quality standards often requires inspection and certification. Delivery period: many contracts have a delivery period rather than a single delivery day, during which the seller can choose to initiate delivery. Delivery process nuances. For a more advanced understanding, specific dates related to physical delivery are important. First notice day. This is the first day on which a short position holder can give notice of their intention to deliver the underlying commodity to a long position holder. Last trading day. This is the last day a futures contract can be traded. After this day, all open positions must either be settled or proceed to delivery. Last delivery day. This is the final day by which the underlying asset must be delivered to fulfill the contract. Let's illustrate the profit and loss P&L calculation for a physically delivered contract. We'll use a code snippet class to encapsulate the contract's parameters and settlement logic. Download the code on OnePageCode Substack. This initial code chunk sets up our code snippet class. We define an code snippet for code snippet to make our code more readable and prevent errors. The code snippet method captures the essential parameters of any futures contract: its ticker, the price at which we entered the trade, the lot size, quantity per contract, and its settling. NT type. The code snippet method provides a clear string representation of our contract object. Now, let's add a method to calculate the P&L at maturity, specifically for physical delivery. Download the code on OnePageCode Substack. This code snippet method is designed to compute the economic P&L for a physically delivered contract. Even though physical goods are exchanged, the financial outcome is still measured by the difference between the original contract price and the spot price at maturity. A long position benefits when the spot price rises above the contract price, as they buy at the lower futures price and could theoretically sell at the higher spot price. Conversely, a short position benefits when the spot price falls below the contract price, as they sell at the higher futures price and could theoretically buy at the lower spot price to cover. Let's apply this to a crude oil example. A crude oil futures contract represents 1,000 barrels. Download the code on OnePageCode Substack. In these examples, we see how the P&L is calculated for a long position. If the spot price at maturity is higher than the contract price, the long position profits. If it's lower, the long position incurs a loss. This reflects the economic reality. A long holder who is obligated to buy at $70 will be happy if they can immediately sell the physically delivered oil at $75, making $5 per barrel. Download the code on OnePageCode Substack. For a short position, the P&L is inverse. If the spot price rises, the short position loses money, as they are obligated to sell at $70 but would have to acquire the oil at $75 to deliver it. If the spot price falls, they profit, as they can acquire the oil at $65 and deliver it to fulfill their obligation to sell at $70. Cash settlement. Cash settlement, also known as financial settlement, does not involve the physical exchange of the underlying asset. Instead, the parties exchange a net cash payment representing the difference between the contract price and the final settlement price, often the spot price at maturity. Typical assets for cash settlement. This method is used when physical delivery is impractical, impossible, or undesirable. Stock index futures: S&P 500, NASDAQ 100, Dow Jones Industrial Average futures. It's impossible to deliver a stock index. Interest rate futures: Eurodollar futures, Treasury bond futures. These represent interest rate exposures, not physical assets. Currency futures: non-deliverable certain emerging market currencies where physical delivery is restricted. Volatility index futures, VIX futures. Single stock futures, less common in some markets. While single stocks can be delivered, cash settlement simplifies the process. Why cash settlement? The primary reason for cash settlement is the nature of the underlying asset. You cannot physically deliver an abstract concept like an interest rate or a volatility index, a basket of hundreds of stocks that constitute an index. A 4. IGN currency if exchange controls or logistical hurdles make physical transfer impractical. Determining the net cash position. The final settlement price for cash-settled contracts is critical. It's usually determined by the exchange on the last trading day and can be closing price, the official closing price of the underlying asset or index on the final trading day. Average price, an average of prices over a specific period, e.g., the last hour of trading, to prevent manipulation. Special opening quotation, SOQ for some index futures, a specific calculation based on the opening prices of constituent stocks on the third Friday of the expiration month. Let's enhance our code snippet class to handle cash settlement and then apply it to a stock index futures example. Download the code on OnePageCode Substack. We've updated the code snippet method. The underlying P&L calculation, difference between final price and contract price, multiplied by lot size, remains the same for both physical and cash settlement, as it always represents the economic gain or loss. The distinction lies in how that gain or loss is realized, through physical exchange or a simple cash transfer. Let's use an S&P 500 futures contract example. The E-mini S&P 500 futures contract has a multiplier, lot size, of $50 per index point. Download the code on one patch code Substack. Similar to physical delivery, a long position in a cash-settled contract profits if the final settlement price is higher than T-Air contract price and loses if it's lower. The key difference is that no actual stocks change hands. Only the net cash difference is transferred. Download the code on one patch code Substack. For a short position in a cash-settled contract, the P&L dynamics are also identical to physically delivered contracts. Profit if the price falls, loss if it rises. The economic exposure is the same, but the method of settlement simplifies the process by avoiding physical transfer. The crucial role of the clearinghouse. Regardless of whether a contract is physically delivered or cash settled, the clearinghouse plays an indispensable role in the futures market. Counterparty to every trade, Novation, the clearinghouse, stands between every buyer and every seller. When a trade is executed, the clearinghouse effectively becomes the seller to every buyer and the buyer to every seller. This process, called novation, eliminates bilateral counterparty risk between individual traders. Performance guarantee. The clearinghouse guarantees the performance of all contracts. This means that a buyer will receive their delivery or cash settlement, even if the original seller defaults, and vice versa. This guarantee is backed by the clearinghouse's capital, its risk management systems, and the margin requirements it imposes on all participants. Facilitating settlement. For physical delivery, the clearinghouse manages the delivery process, ensuring that the seller's notice of intent to deliver is matched with an appropriate long position holder. For cash settlement, it calculates the final settlement price and facilitates the net cash transfers between accounts. Risk management. Through daily market-to-market and margin calls, the clearinghouse mitigates the risk of default by ensuring that traders maintain sufficient funds to cover potential losses. This continuous monitoring is what makes the guarantee of performance feasible. Closing out positions before maturity. The offsetting transaction. While physical delivery and cash settlement are the ultimate obligations at maturity, the vast majority of futures contracts, over 95% for most markets, are closed out before their expiration date. This is achieved through an offsetting transaction. An offsetting transaction involves taking an opposite and identical position to your existing one in the same contract. If you're long one futures contract, you sell one identical futures contract to offset. If you are short one futures contract, you buy one identical futures contract to offset. When you execute an offsetting trade, your original position is effectively canceled out, and your obligation to deliver or receive the underlying asset, or cash settlement, at maturity is extinguished. Any P&L accrued on the position is realized immediately at the time of the offset. Why traders prefer offsetting? Avoidance of logistics. Speculators, in particular, have no interest in taking physical delivery of crude oil or delivering corn. Offsetting allows them to profit from price movements without dealing with the complexities and costs of physical logistics. Liquidity. Futures markets are designed for active trading. The ease of entering and exiting positions through offsetting transactions contributes to high market liquidity. Focus on price movement. For many traders, futures contracts are purely tools for speculating on price direction or hedging price risk. The actual underlying asset is less relevant than its price. Let's demonstrate how an offsetting transaction works and its impact on P&L. We'll add a method to simulate this. Download the code on one patch code Substack. The code snippet method calculates the P&L realized when a position is closed out. The logic is very similar to the maturity P&L, but the final price is now the code snippet at which the opposing trade was executed. Download the code on one patch code Substack. These examples clearly show how an offsetting transaction immediately crystallizes the P&L. A long position profits if they can sell the offsetting contract at a higher price than their original purchase. A short position profits if they can buy the offsetting contract at a lower price than their original sale. The original obligation simply disappears. Comparison and best practices. Understanding the obligations at maturity is foundational, even if most contracts are offset. It informs key aspects of trading and risk management. Contract specifications. A. Will always know the settlement type of the futures contract you are trading. This information is readily available from the exchange or your broker. Delivery logistics. If you intend to hold a physically delivered contract to maturity, e.g., for hedging purposes, be fully aware of the logistical requirements, approved delivery locations, and associated costs. Liquidity management. For highly liquid contracts, offsetting is straightforward. For less liquid contracts, finding an offsetting party might be more challenging, potentially leading to wider bid-ask spreads or difficulty exiting a position at a desired price. Roll-over strategy. Traders who wish to maintain their exposure beyond a contract's maturity date will typically roll over their position. This involves simultaneously closing out the expiring contract via an offsetting transaction and opening a new position in a futures contract for a later maturity date. This is a common practice for continuous exposure to a commodity or index. Common pitfalls. Forgetting expiration dates. Failing to close out a position before the last trading day can lead to unintended physical delivery obligations or forced cash settlement. Underestimating delivery costs. For those who do go to physical delivery, the costs of storage, transportation, and quality assurance can significantly erode potential profits or exacerbate losses. Illiquidity near maturity. As a contract approaches its last trading day, its liquidity often decreases. SES, as most participants have already offset their positions. This can make it difficult to get a favorable price for an offsetting trade. By understanding both the ultimate obligations of settlement and the prevalent practice of offsetting, traders can navigate the futures markets effectively, managing their risk and realizing their intended economic outcomes. Leverage in a futures contract. Leverage is a fundamental characteristic of futures trading, allowing participants to control a large notional value of an asset with a relatively small amount of capital. This amplification effect is made possible by the margin system, which serves as a performance bond rather than a down payment. While leverage can significantly amplify potential profits, it equally amplifies potential losses, making it a double-edged sword that necessitates robust risk management. The mechanism of leverage. In futures trading, leverage arises because the initial margin required to open a position is only a fraction of the total notional value of the contract. Unlike purchasing an asset outright, where you pay the full price, futures contracts require only a good faith deposit to cover potential adverse price movements. To understand this, consider the key components. Contract value. Notional value. This is the total value of the underlying asset controlled by one futures contract. It's calculated as code snippet. For example, if a crude oil futures contract is priced at $70 per barrel and controls 1,000 barrels, its notional value is $70,000. Initial margin, the amount of capital required to open a single futures position. This is set by the exchange and clearinghouse, typically representing a small percentage, e.g., 5 to 15% of the contract's notional value. The significant difference between the contract's notional value and the initial margin creates leverage. Calculating the leverage ratio. The leverage ratio quantifies how much larger the notional value of the position is compared to the capital committed, initial margin. The formula for the leverage ratio is code snippet. Let's illustrate this with an example. Consider a hypothetical crude oil futures contract. Current price, $70 per barrel. Contract size, 1,000 barrels per contract. Initial margin, $3,500 per contract. First, we calculate the contract's notional value. Code snippet. Now, we can calculate the leverage ratio. Code snippet. This means that for every $1 of initial margin deposited, you control $20 worth of the underlying asset. A leverage ratio of 20 implies a 20x leverage. We can implement a simple Python function to calculate this. Download the code on OnePageCode Substack. This code snippet defines a function code snippet that takes the current price, contract size, and initial margin as inputs. It first computes the code snippet notional value, and then divides it by the code snippet to determine the leverage ratio. The example demonstrates its application for a crude oil futures contract, showing a 20x leverage. Amplified profits and losses. The primary consequence of leverage is the amplification of both profits and losses relative to the initial capital invested. A small percentage change in the underlying asset's price can translate into a significantly larger percentage gain or loss on the initial margin. Let's continue with our crude oil example. Suppose you buy one crude oil futures contract at $70 and the price moves to $71. Price change, plus $1.00 per barrel. Total profit, absolute $1 per barrel times 1,000 barrels equals $1,000. Now, let's look at this profit relative to the initial margin. Initial margin, $3,500. Percentage return on initial margin, $1,000/$3,500 times 100% equals 28.57%. A mere 1.43% price increase, $1/$70, 100%, in the underlying asset resulted in a nearly 29% return on the initial capital committed. This demonstrates the power of leverage. Conversely, if the price moved down to $69, you would incur a loss of $1,000, which would also be a 28.57% loss on your initial margin. This highlights the symmetric risk of leverage. We can model this profit and loss calculation in Python. Download the code on OnePageCode Substack. The code snippet function computes the total profit or loss based on the price change and contract size. The code snippet then translates this absolute P&L into a percentage of the initial capital. Running the examples confirms how a small price fluctuation leads to a disproportionately large percentage change on the margin. Understanding margin calls. The margin system is dynamically adjusted daily through a process called marking to market. At the end of each trading day, the profit or loss from your futures position is added to or subtracted from your margin account. This ensures that the clearinghouse always has sufficient collateral to cover potent deal losses. A margin call occurs when the balance in your margin account falls below a specified threshold, known as the maintenance margin. The maintenance margin is typically a percentage of the initial margin, e.g., 75 to 80%. Its purpose is to ensure that traders maintain a minimum level of equity in their account to cover future potential losses. When a margin call is triggered, the trader is required to deposit additional funds to bring their margin account balance back up to the initial margin level. Step-by-step margin call example. Let's use our crude oil contract example and track the margin account over several days. Contract parameters. Initial margin, $3,500. Maintenance margin, $2,800, 80% of initial margin. Contract size, 1,000 barrels. Tick value, 1 cent per barrel, smallest price increment, so $10 per full point move. Position, long one contract, entered at $70. Day 0, account setup. Initial deposit, $3,500, equal to initial margin. Margin account balance, $3,500. Day 1, price movement. Opening price, $70. Closing price, $70.50. Daily P&L, $70.50 to $70. 1,000 equals plus $500. New margin account balance, $3,500 plus $500 equals $4,000. Check for margin call, $4,000 greater than $2,800. Maintenance margin, no margin call. Day 2, price movement loss. Opening price, $70.50. Closing price, $68. Daily P&L, $68 to $70.50. 1,000 equals minus $2,500. New margin account balance. $4,000 to $2,500 equals $1,500. Check for margin call. $1,500 less than $2,800. Maintenance margin, margin call TR. IGRD. Calculating the margin call amount. The amount required is to bring the account back to the initial margin. Required balance. $3,500 initial margin. Current balance. $1,500. Margin call amount. $3,500 to $1,500 equals $2,000. The trader must deposit $2,000 to bring their margin account back to $3,500. Consequence of not meeting a margin call. If the trader fails to meet the margin call within the specified time frame, typically 24 to 48 hours, the broker has the right to forcefully liquidate the position. This means the contract will be sold or bought, if short, at the current market price, potentially locking in significant losses for the trader. This protects the clearinghouse and the broker from further potential losses. Simulating margin account and margin calls. We can build a Python simulation to track the margin account balance and detect margin calls over a series of trading days. Download the code on OnePageCode Substack. This initial setup block defines the core parameters of our hypothetical futures contract and initializes the margin account with the code snippet. It also sets the code snippet and code snippet for P&L tracking. Next, we define a function to calculate daily P&L and update the margin account. Download the code on OnePageCode Substack. The code snippet function is crucial for simulating the marking-to-market process. It takes the current account balance, the previous day's settlement price, and the current day's settlement price to calculate either daily profit or loss. This P&L is then added to the code snippet to get the code snippet. Now, we add the logic to check for a margin call and determine the required deposit. Download the code on OnePageCode Substack. The code snippet function takes the current balance and compares it against the code snippet, adjusted for the number of contracts. If the balance falls below this threshold, it calculates the code snippet to restore the account to the code snippet level. Finally, we integrate these functions into a simulation loop with a series of daily prices. Download the code on OnePageCode Substack. This final block iterates through a list of code snippet. For each day, it calls the code snippet function to reflect the marking to market. Then, it uses code snippet to determine if additional funds are required. The output clearly shows the daily P&L, the evolving margin account balance, and details any trigger margin calls, including the precise amount needed to bring the account back to the initial margin level. The simulation also includes a print statement for what happens if the margin call is met, demonstrating the recovery of the account. In a real-world scenario, failure to meet the call would lead to liquidation. Risk management in leverage trading. Given the magnified impact of price movements due to leverage, robust risk management is paramount in futures trading. Without proper controls, even small adverse price swings can quickly deplete a trading account. Key risk management strategies include 1. Position sizing. This is perhaps the most critical aspect. Instead of trading the maximum number of contracts allowed by your margin, determine a position size that limits your potential loss to a small, acceptable percentage of your total trading capital. For example, if you risk 1% of your capital per trade, calculate how many contracts correspond to that risk given your stop-loss level. Never over-leverage. 2. Stop-loss orders. These are preset instructions to close a position automatically once a specified price level is reached, limiting potential losses. A stop-loss should be determined before entering a trade, based on your risk tolerance and market analysis, not arbitrarily. 3. Understanding volatility. Futures markets, especially for commodities or indices, can be highly volatile. Higher volatility means larger potential price swings, which can quickly trigger margin calls or stop losses. Adjust position sizes and stop-loss distances based on the underlying asset's typical volatility. 4. Monitoring margin account. Regularly monitor your margin account balance throughout the trading day, not just at settlement. Many brokers provide real-time margin balances. Being aware of your equity cushion helps in proactive decision-making. 5. Diversification, carefully applied while a single futures contract focuses on one asset. For a broader portfolio, diversification across different asset classes, e.g., equity index FUT, yours, bond futures, commodity futures, can help manage overall portfolio risk, as different markets may not move in perfect correlation. However, within a single futures position, diversification isn't directly applicable. 6. Capital adequacy. Always ensure you have sufficient capital beyond just the initial margin. This buffer helps absorb daily losses without immediately triggering margin calls and provides the flexibility to meet margin calls if they occur, preventing forced liquidation. By diligently applying these principles, traders can harness the power of leverage while mitigating its inherent risks, making futures a viable tool for both speculation and hedging. The clearinghouse, the unseen pillar of futures markets. In the dynamic world of futures trading, where participants commit to buying or selling assets at a future date, a critical question arises. How can a buyer be sure the seller will deliver, and vice versa? What if one party defaults on their obligation? This is where the clearinghouse steps in, acting as an indispensable central intermediary that underpins the security, integrity, and efficiency of exchange-traded derivatives markets. At its core, a clearinghouse is a financial institution that facilitates the exchange of payments and securities, acting as a guarantor for all trades. For futures contracts, its primary role is to mitigate counterparty risk, the risk that one party to a financial contract will fail to honor their obligations. Without a clearinghouse, every buyer would face the risk of their specific seller defaulting, and every seller would face the risk of their specific buyer defaulting. This direct exposure to individual counterparty creditworthiness would severely limit market participation and liquidity. Eliminating counterparty risk. The principle of novation. The most fundamental mechanism by which a clearinghouse eliminates counterparty risk is through a legal process called novation. When a futures trade is executed on an exchange, the clearinghouse immediately interposes itself between the original buyer and seller. This means that the clearinghouse legally becomes 1. The seller to every buyer. 2. The buyer to every seller. Consider a simple example. Trader A wants to buy 10 futures contracts. Trader B wants to sell 10 futures contracts. When their orders match on the exchange, the clearinghouse performs novation. The original contract between Trader A and Trader B is extinguished and replaced by 2 new contracts. Trader A now has a contract to buy 10 futures from the clearinghouse. Trader B now has a contract to sell 10 futures to the clearinghouse. From this point forward, neither Trader A nor Trader B has any direct credit exposure to each other. Their sole counterparty for the futures contract is the highly capitalized and regulated clearinghouse. This transformation is crucial because it mutualizes and centralizes risk, replacing numerous bilateral counterparty risks with a single, robust counterparty. Key functions of a clearinghouse. Beyond novation, clearinghouses perform several vital functions that ensure the smooth operation and stability of futures markets. 1. Trade validation and finalization. Upon execution on the exchange, trades are immediately reported to the clearinghouse. The clearinghouse verifies all trade details, price, quantity, instrument, participants to ensure accuracy. Once validated, the trade is registered or finalized in the clearinghouse's books, making it a binding obligation between the clearinghouse and the clearing members. 2. Order matching and execution linkage. While the exchange is responsible for the initial matching of buy and sell orders, the clearinghouse acts as the ultimate record keeper and facilitator of the resulting obligations. It ensures that every matched trade translates into a clear, enforceable obligation for its clearing members. 3. Margin monitoring and management. Perhaps the most continuous and critical function, the clearinghouse manages the margin system. As discussed in previous sections, margins are good faith deposits required from both buyers and sellers to cover potential losses. The clearinghouse calculates and collects initial margin and processes variation margin, or mark-to-market payments, daily. This daily mark-to-market process involves revaluing all open positions to current market prices at the end of each trading day. If a participant's position has incurred losses, the clearinghouse issues a margin call, requiring them to deposit additional funds to bring their margin account back up to the required level. Conversely, participants with profitable positions receive variation margin payments. This continuous monitoring and adjustment of margin ensures that the clearinghouse is always adequately collateralized against potential defaults, minimizing its own exposure. 4. Position management. The clearinghouse maintains a complete record of all open positions for all its clearing members. This includes tracking new trades, offsets, closing positions, and deliveries or cash settlements at maturity. The tiered S. Structure. Clearing members and non-clearing members. Direct access to a clearinghouse is typically restricted to a select group of highly capitalized financial institutions known as clearing members. These are usually large banks, brokerage firms, or proprietary trading firms that meet stringent financial and operational requirements set by the clearinghouse. The relationship structure is tiered. Clearinghouse, the central counterparty. Clearing members, direct participants with the clearinghouse. They have the financial strength and operational capabilities to meet margin requirements and absorb potential losses. Non-clearing members, or clients, individual traders, hedge funds, corporations, or smaller brokerage firms who do not have direct access to the clearinghouse. They must conduct their futures trading through a clearing member. The flow of funds, margins, follows this hierarchy. 1. A non-clearing member, e.g., an individual trader, places a trade through their broker, who is a clearing member. 2. The non-clearing member deposits initial margin with their clearing member. 3. The clearing member, in turn, deposits the aggregated margin for all its clients, plus its own proprietary trading margin, with the clearinghouse. 4. Variation margin payments also flow through this chain, from the clearinghouse to the clearing member, and then to the non-clearing member for gains, or from the non-clearing member to the clearing member, and then to the clearinghouse. C. Follosis. This tiered structure ensures that the clearinghouse only deals with a manageable number of robust entities, simplifying its risk management and oversight. The clearing members act as a crucial buffer, absorbing the initial impact of defaults by their own clients before any losses potentially reach the clearinghouse. Safeguarding the market, the default fund. Even with robust margin requirements, there's always a theoretical possibility that a major clearing member could default on its obligations, with losses exceeding its posted margin. To address this tail risk, clearing houses maintain a default fund, also known as a guarantee fund or mutualized default fund. The default fund is a pool of capital contributed by all clearing members. It serves as a collective insurance policy, acting as a second line of defense after a defaulting member's own margin to cover losses arising from a clearing member's failure. The structure for absorbing losses in such an extreme event typically follows a predefined waterfall mechanism. 1. Defaulter's initial and variation margin. The defaulting clearing member's own posted margin is used first. 2. Defaulter's contribution to the default fund. The defaulting member's pre-funded contribution to the default fund is then utilized. 3. Clearinghouse's own capital. The clearinghouse typically contributes a portion of its own capital. 4. Non-defaulting clearing members' contributions to the default fund. The contribution S from the remaining non-defaulting clearing members are then tapped. 5. Assessment powers. If applicable in some cases, clearing houses may have the power to make additional assessments or calls for more capital from non-defaulting members up to a predefined limit. This multi-layered defense mechanism, culminating in the default fund, is designed to prevent a single clearing member default from spiraling into a systemic crisis that could destabilize the entire market. The trade life cycle through the clearinghouse. To solidify understanding, let's trace a futures trade from initiation to settlement, highlighting the clearinghouse's involvement. 1. Order placement. A trader, non-clearing member, instructs their broker, clearing member, to buy or sell a futures contract. 2. Order execution. The broker transmits the order to the futures exchange. The exchange's matching engine finds a counterparty and executes the trade. 3. Trade reporting. The exchange immediately sends the details of the matched trade to the clearinghouse. 4. Novation and registration. The clearinghouse instantaneously interposes itself, becoming the buyer to the seller and the seller to the buyer. The trade is registered in the clearinghouse's books as two separate contracts, one with each clearing member involved. 5. Initial margin call. The clearinghouse calculates and requires initial margin from both clearing members, representing their clients' positions. These funds flow from the non-CL clearing member to the clearing member, and then from the clearing member to the clearinghouse. 6. Daily mark-to-market, variation margin every trading day. The clearinghouse revalues all open positions to the current market price. If a clearing member's positions, on behalf of their clients, incur losses, the clearinghouse issues a variation margin call. The clearing member must pay these funds to the clearinghouse. This payment is passed on from the non-clearing member to the clearing member. If a clearing member's positions accrue gains, the clearinghouse pays variation margin to the clearing member. This payment is passed on from the clearing member to the non-clearing member. 7. Position offset or maturity. Offset. If the trader decides to close their position before maturity, they enter an opposite trade. For example, if they initially bought, they now sell the same contract. The clearinghouse matches these offsetting positions and extinguishes the original obligation, returning the initial margin. Maturity. If the position is held until maturity, the clearinghouse facilitates the final settlement, either through physical delivery of the underlying asset or through cash settlement, as per the contract specifications. Real-world examples and broader implications. Globally, several prominent clearinghouses serve major futures markets. CME Clearing. The clearing arm of CME Group, clearing futures and options across various asset classes, including interest-R. ATESH, equities, foreign exchange, and commodities. LCH, a leading global clearinghouse, clearing a vast array of instruments including interest rate swaps, foreign exchange, and commodities. Eurex Clearing, the clearinghouse for Eurex Exchange, primarily clearing European derivatives. The role of the clearinghouse extends beyond merely mitigating counterparty risk. By standardizing contracts, centralizing risk management, and ensuring the integrity of the settlement process, clearinghouses also contribute significantly to price discovery. By providing a secure and transparent environment, they encourage greater participation, which leads to more robust and accurate price discovery. Market liquidity. The elimination of bilateral counterparty risk makes it easier for participants to enter and exit positions, thereby enhancing market liquidity. Systemic financial stability. As demonstrated during financial crises, the robust risk management frameworks of clearinghouses, particularly their margin systems and default funds, act as vital shock absorbers, preventing individual defaults from cascading into widespread market failures. They are considered crucial components of the financial infrastructure. In essence, the clearinghouse is the silent guardian of the futures market, providing the trust and infrastructure necessary for participants to trade with confidence, knowing that their obligations will be honored regardless of their specific counterparty's credit worth. Highness. Mark-to-market. Mark-to-market, MTM, is a fundamental daily settlement process in futures trading. Its primary purpose is to realize profits and losses on open futures positions daily, thereby ensuring continuous collateralization and mitigating counterparty risk for all participants, especially the clearinghouse. This mechanism transforms theoretical gains and losses into actual cash flows, maintaining the integrity of the financial system by preventing large, accumulated defaults. The daily settlement process. Unlike traditional stock trading, where profit or loss is only realized upon closing a position, futures contracts undergo a daily settlement. This means that at the end of each trading day, every open futures position is marked to market based on the day's official settlement price. The resulting profit or loss is then immediately credited to or debited from the trader's margin account. This process reinforces the zero-sum game nature of futures contracts, as discussed in previous sections. For every dollar gained by a long position holder, a corresponding dollar is lost by a short position holder, and vice versa. The clearinghouse acts as the central counterparty, facilitating this precise daily transfer of funds. The mark-to-market process typically involves the following steps. 1. Determination of the settlement price. At the close of each trading day, the exchange determines an official settlement price for each futures contract. This price is often an average of trades occurring during a specific closing period, or it might be set by a dedicated closing auction. It serves as the reference point for calculating daily gains and losses. This differs from the last traded price, which can be subject to spikes or anomalies. 2. Calculation of daily profit/loss, P&L for each open contract. The daily P&L is calculated based on the difference between the current day's settlement price and the previous day's settlement price. The formula is code snippet for a long position. If the current settlement price is higher than the previous day's, the long position records a profit. If it's lower, a loss. For a short position, if the current settlement price is lower than the previous day's, the short position records a profit. If it's higher, a loss. 3. Adjustment of margin accounts. The calculated daily P&L is then immediately added to or subtracted from the trader's margin account. If a profit is realized, the margin account balance increases. If a loss is incurred, the margin account balance decreases. 4. Margin call check. After the margin account is adjusted, the clearinghouse, or the broker, checks if the account balance still meets the code snippet requirement. If the margin account balance falls below the maintenance margin, a code snippet is triggered, requiring the trader to deposit additional funds to bring the account back up to the initial margin level. While daily mark-to-market is the standard for extremely volatile instruments or during periods of high market stress, some exchanges or clearinghouses may perform intraday mark-to-market calculations to ensure even tighter risk control. Numerical example: a multi-day mark-to-market cycle. Let's walk through a detailed numerical example for both a long and a short position to illustrate the mark-to-market process over several trading days. Scenario setup. Contract. Crude oil futures, CL. Contract multiplier, 1,000 barrels per contract. Initial margin, $8,000 per contract. Maintenance margin, $6,000 per contract. Trader A goes long 1 CL contract at $75. Trader B goes short 1 CL contract at $75. Daily settlement prices. Day 0, entry $75, initial trade price. Day 1, settlement $76.50. Day 2, settlement $74.80. Day 3, settlement $73. Day 4, settlement $73.50. Trader A, long position. Day previous settlement price, current settlement price, change daily P&L per contract. Margin account balance, margin call trigger. Action. Zero, not applicable, $75. Entry, not applicable, $8,000. Initial, no open long position at $75. $175, $76.50 plus $1.50 plus $1, 500 plus 1.50 /1000. $8,000 plus $1,500 equals $9,500. No profit credited. $276.50, $74.80 minus $1.70 minus $1,700 minus 1.70 /1000. $9,500 to $1,700 equals $7,800. No loss debited. $374.80, $73 minus $1.80 minus $1,800 minus 1.80 /1000. $7,800 to $1,800 equals $6,000. Yes. Balance equals mate. Margin. Trader must deposit $2,000 to bring balance back to $8,000. initial margin. If not, forced liquidation. 3. After deposit. Not applicable, not applicable, not applicable, not applicable. $6,000 plus $2,000 equals $8,000. No margin call met. $473, $73.50 plus $0.50 plus $500 plus 0.50 backslash 1,000. $8,000 plus $500 equals $8,500. No profit credited. Trader B, short position. Day previous settlement price, current settlement price, change daily P&L, per contract. Margin account balance margin call trigger. Action. Zero not applicable $75. Entry. Not applicable $8,000. Initial. No open short position at $75. $175, $76.50 plus $1.50 minus $1,500 minus 1.50 backslash 1,000. $8,000 to $1,500 equals $6,500. No loss debited. $276.50, $74.80 minus $1.70 plus $1. 700 plus 1.70 backslash 1,000. $6,500 plus $1,700 equals $8,200. No profit credited. $374.80, $73 minus $1.80 plus $1. 800 plus 1.80 backslash 1,000. $8,200 plus $1,800 equals $10,000. No profit credited. $473, $73.50 plus $0.50 minus $500 minus 0.50 backslash 1,000. $10,000 to $500 equals $9,500. No loss debited. Notice the symmetry. When trader A, long, experiences a profit, trader B, short, experiences a loss of the same magnitude, and vice versa. This highlights the clearing house's role in facilitating direct transfer of funds. Programmatic simulation of mark-to-market. Simulating the mark-to-market process programmatically allows us to better understand its mechanics and build tools for backtesting or real-time risk management. We'll use Python to model the entities involved in the daily operations. First, let's define a class to represent our code snippet. This will hold static information about the contract itself, like its unique identifier and multiplier. Download the code on OnePageCode Substack. The code snippet class encapsulates the fundamental properties of a futures contract, such as its code snippet, e.g., CL for crude oil, and its code snippet, also known as the contract multiplier or lot size. This code snippet is crucial as it determines the monetary value of each price movement. For example, a crude oil futures contract with a code snippet of 1,000 means that every $1 change in price per barrel translates to a $1,000 change in the contract value. Next, we'll define a code snippet class. This class will manage the dynamic state of a trader's position, including their margin balance, the type and number of contracts held, and the initial and maintenance margin requirements. Download the code on OnePageCode Substack. The code snippet class is central to our simulation. It holds crucial information like the code snippet, which will fluctuate daily, and the code snippet and code snippet thresholds. The code snippet, or code snippet, is vital for correctly calculating P&L, as gains for a long position are losses for a short, and vice versa. We also store code snippet and the code snippet to keep track of the original position details. Code snippet is initialized with the code snippet and will be updated daily. Now, let's implement the core logic for calculating daily P&L, updating the margin account, and checking for margin calls. These will be standalone functions, making them reusable and testable. Download the code on OnePageCode Substack. The code snippet function takes the critical parameters for P&L calculation: price change, contract size, and number of contracts. It applies conditional logic to correctly determine profit or loss based on whether the position is code snippet or code snippet. The code snippet function is straightforward, simply adding or subtracting the code snippet. The code snippet function implements the core margin call logic. If the code snippet drops below the code snippet, it calculates the amount needed to restore the balance to the code snippet level. Finally, we'll put it all together in a simulation loop. This loop will iterate through a series of daily settlement prices, applying the mark-to-market logic for each day. Download the code on OnePageCode Substack. The code snippet function orchestrates the entire process. It takes a code snippet, and a dictionary of code snippet as input. It iterates through the sorted dates, performing the P&L calculation dating the margin account, and checking for margin calls for each day. For simplicity in the simulation, it assumes that any triggered margin call is immediately met. Let's use our example data to run the simulation for both trader A, long, and trader B, short. Download the code on OnePageCode Substack. This code snippet script initializes the code snippet and two code snippet objects, one long, one short, with the parameters from our numerical example. It then calls code snippet for each trader, printing out the step-by-step changes to their margin accounts, including any margin calls, exactly mirroring the manual calculations. The role of margin calls and risk management. A margin call is not merely an inconvenience. It is a critical risk management tool. When a trader's margin balance falls below the maintenance margin, it signifies that their losses have eroded a significant portion of their collateral. The margin call serves as an immediate demand for additional funds to bring the account equity back up to the initial margin level. Practical implications of a margin call. Topping up. The most common response is for the trader to deposit the required funds into their account, restoring their margin balance and allowing them to maintain their position. Forced liquidation. If a trader fails to meet a margin call within the specified time frame, which can be very short, sometimes hours, the clearinghouse or the broker has the right, and often the obligation, to forcibly liquidate, close out, some or all of the trader's positions to cover the losses. This is a severe consequence as it locks in losses and removes the opportunity for the position to recover. It's a crucial mechanism to prevent a trader's losses from exceeding their available capital, thereby protecting the clearinghouse and other market participants from counterparty default. Mark-to-market, combined with the margin system, effectively manages credit risk for all parties. For the clearinghouse, it ensures that potential losses are covered daily, preventing the accumulation of large, uncollateralized debts from defaulting traders. This greatly reduces systemic risk in the futures market. For individual traders, while it requires active management of margin accounts, it also forces traders to acknowledge and cover their losses promptly. This prevents runaway losses that could otherwise occur if losses were allowed to accumulate without daily settlement. It encourages disciplined risk management and position sizing. Modern trading platforms display real-time P&L and margin status, directly reflecting the ongoing mark-to-market process. Traders can see their excess margin, the amount above maintenance margin, or deficit, if below maintenance margin, allowing them to proactively manage their accounts and avoid margin calls. Maintaining the effective price. Despite the daily cash flows associated with mark-to-market, the overall profit or loss from a futures position is still fundamentally determined by the difference between the original entry price and the final exit price, or the current settlement price if the position is still open. Consider our trader who went long at $75. On day 4, the settlement price is $73.50. Their total unrealized loss at this point is code snippet. Let's sum up their daily P&L. Day 1, plus $1, 500. Day 2, minus $1,700. Day 3, minus $1,800 and a $2,000 margin call met. Day 4, plus $500. Total P&L excluding the margin call deposit. Code snippet. This matches the unrealized loss based on the current settlement price. The mark-to-market process effectively resets the contract's basis price to the settlement price at the end of each day. So, when calculating the next day's P&L, it's as if the trader entered a new position at the previous day's settlement price. The daily cash flows simply distribute the total profit or loss over the life of the contract, ensuring that the clearinghouse always holds sufficient collateral to cover potential losses. The effective price of the position continually moves to the latest settlement price, but the cumulative P&L accurately reflects the difference between the initial entry price and the current market price. Pricing forward contract. Having established the fundamental mechanics of futures and forward contracts, including concepts like leverage, the clearinghouse, and mark-to-market mechanisms, we now transition to a critical quantitative aspect: how these contracts are theoretically priced. Understanding the fair value of a forward contract is essential for identifying potential mispricings and understanding the underlying economics that drive derivatives markets. The pricing of a forward contract is primarily driven by the no-arbitrage principle. This principle asserts that in an efficient market, it should not be possible to make a risk-free profit without any initial investment. Any deviation from this principle would immediately be exploited by market participants, quickly driving prices back to their no-arbitrage equilibrium. The no-arbitrage principle. At its core, the no-arbitrage principle is a fundamental cornerstone of financial economics, particularly in the valuation of derivatives. An arbitrage opportunity exists when an investor can construct a portfolio of assets that guarantees a positive return with no risk and no net investment. In liquid markets, such opportunities are fleeting, as sophisticated traders quickly identify and exploit them, causing prices to adjust until the arbitrage profit disappears. For forward contracts, this means that the theoretical forward price must be consistent with the spot price of the underlying asset and the prevailing risk-free interest rate. If the market forward price deviates from this theoretical value, an arbitrage strategy can be constructed to exploit the mispricing. Assumptions for simple forward pricing. Before diving into the derivation, it's crucial to understand the simplifying assumptions made in the basic no-arbitrage forward pricing model. These assumptions allow for a clear and concise derivation, forming a baseline understanding. In real-world scenarios, some of these assumptions may not hold perfectly, leading to minor deviations in market prices, which we will discuss later. The key assumptions are: no dividends. The underlying asset does not pay any dividends during the life of the forward contract. This assumption will be relaxed in more advanced models. No storage costs. The underlying asset does not incur any storage or carrying costs, e.g., for commodities. No transaction costs. There are no fees or commissions incurred when buying or selling the underlying asset or entering into the forward contract. No taxes. All transactions are tax-free. Identical borrowing and lending rates. Market participants can borrow and lend money at the same risk-free rate. Continuous compounding. Interest rates are compounded continuously. Perfect divisibility. Assets can be bought or sold in any fractional quantity. Ability to short sell. It is possible to short sell the underlying asset without any restrictions or costs. Derivation of the forward price formula. The derivation the forward price formula relies on constructing a replicating portfolio. A replicating portfolio is a combination of existing assets, like the underlying asset and cash, that precisely matches the payoff of the derivative instrument, the forward contract, at its expiration. If two different investment strategies produce identical cash flows and payoffs at the same future point in time, then to prevent arbitrage, their initial costs, or values, must also be identical. Let's denote. Code snippet. The current spot price of the underlying asset. Code snippet. The forward price of the contract agreed upon today for delivery at time code snippet. Code snippet. The continuously compounded risk-free interest rate, annualized. Code snippet. The time to maturity of the forward contract in years. We will demonstrate the derivation by considering two distinct strategies that achieve the same outcome at time code snippet. Strategy 1. Create a synthetic long forward position. Imagine we want to replicate the payoff of being long a forward contract, meaning we want to own the asset at time code snippet for a predetermined price code snippet. At time t equals 0 today. Action. Borrow code snippet dollars at the risk-free rate code snippet for code snippet years. Simultaneously, use the borrowed code snippet dollars to buy 1 unit of the underlying asset in the spot market. Cash flow. Net cash flow is code snippet, borrowed code snippet, spent code snippet. You now own the asset. At time T, maturity. Action. You own the asset. You must repay the loan, including interest. Cash flow. The amount to repay is code snippet. This is a cash outflow. Outcome. You own the asset, and you have a liability of code snippet. This is equivalent to having entered a forward contract to buy the asset at code snippet. Strategy 2. Enter a forward contract. At time T equals 0 today. Action. Enter into a long forward contract to buy 1 unit of the asset at price code snippet at time code snippet. Cash flow. Net cash flow is code snippet. No money changes hands up front for a forward contract. At time T, maturity. Action. You are obligated to buy the asset at the agreed upon forward price code snippet. Cash flow. You pay code snippet dollars to receive the asset. This is a cash outflow. Outcome. You own the asset, and you have paid code snippet dollars for it. The no-arbitrage link. Since both Strategy 1, synthetically creating a long forward, and Strategy 2, entering a forward contract, result in you owning the asset at time code snippet, and both require zero initial investment, their future cash flows must be identical to prevent arbitrage. Therefore, the cost of acquiring the asset at time code snippet must be the same for both strategies. Code snippet. This is the fundamental no-arbitrage pricing formula for a forward contract on a non-dividend paying asset. Let's implement a simple Python function to calculate this theoretical forward price. Download. See the code on OnePageCode Substack. This function takes the spot price code snippet, the risk-free rate code snippet, and the time to maturity code snippet as inputs and returns the calculated forward price. Let's use a numerical example to illustrate. Download the code on OnePageCode Substack. In this example, with a spot price of $100, a 5% risk-free rate, and 1 year to maturity, the theoretical forward price is approximately $105.13. This means that an investor would be indifferent between buying the asset today and holding it for a year, incurring financing costs, or entering into a forward contract to buy it in a year at $105.13. Understanding continuous compounding. The term code snippet in the formula signifies continuous compounding. In finance, continuous compounding is often used because it simplifies mathematical models and provides a good approximation for very frequent compounding periods. Discrete compounding. Interest is calculated and added to the principal at specific intervals, e.g., annually, semi-annually, quarterly, monthly, daily. The formula for discrete compounding is code snippet, where code snippet is the number of compounding periods per year. Continuous compounding. This is the theoretical limit as the number of compounding periods code snippet approaches infinity. The formula simplifies to code snippet, where code snippet is Euler's number, approximately 2.71828. Let's compare discrete and continuous compounding with a numerical example. Using Python. Download the code on OnePageCode Substack. Now, let's apply these functions to demonstrate the effect of compounding frequency. Download the code on OnePageCode Substack. As the compounding frequency increases from annually to daily, the future value approaches the value obtained from continuous compounding. Continuous compounding represents the maximum possible growth rate for a given interest rate and time period. Arbitrage opportunities. The no-arbitrage principle dictates that the observed market forward price, code snippet, should be equal to the theoretical no-arbitrage forward price, code snippet. If code snippet deviates from code snippet, an arbitrage opportunity arises, allowing for a risk-free profit. Let's analyze the two possible scenarios of mispricing. Scenario 1. Forward contract is overpriced, code snippet. If the market forward price is higher than its theoretical fair value, an arbitrageur can profit by selling the overpriced forward contract and simultaneously creating a synthetic long forward position. Arbitrage strategy. 1. Sell the forward contract. Enter a short position in the forward contract at code snippet. This means you agree to sell the asset at code snippet at time code snippet. No cash flow at t equals 0. 2. Replicate a long forward position. Borrow code snippet dollars at the risk-free rate code snippet for code snippet years. Cash inflow code snippet at t equals 0. Use the borrowed code snippet dollars to buy 1 unit of the underlying asset in the spot market. Cash outflow code snippet at t equals 0. Net cash flow at t equals 0. 0. Cash flows at time t maturity. 1. From selling the forward, you are obligated to deliver the asset. You receive code snippet for it. Cash inflow code snippet. 2. From replicating long forward, you own the asset from step 2 at t equals 0. You must repay the loan. Code snippet. Cash outflow code snippet. Total profit at time t. Code snippet. Since code snippet, this profit is positive and risk-free. Let's illustrate with a numerical example. Spot price, S, equals $100. Risk-free rate, R, equals 5%, 0.05. Time to maturity, T, equals 1 year. Theoretical forward price, code snippet, equals $100 E carat, 0.051, equals $105.13. Market forward price, code snippet, equals $108, overpriced. Download the code on OnePageCode Substack. The positive profit of $2.87 confirms the arbitrage opportunity. Scenario 2. Forward contract is underpriced, code snippet. If the market forward price is lower than its theoretical fair value, an arbitrageur can profit by buying the underpriced forward contract and simultaneously creating a synthetic short forward position. Arbitrage strategy. 1. Buy the forward contract. Enter a long position in the forward contract at code snippet. This means you agree to buy the asset at code snippet at time code snippet. No cash flow at t equals 0. 2. Replicate a short forward position. Short sell 1 unit of the underlying asset in the spot market. Cash inflow code snippet at t equals 0. Lend the proceeds code snippet dollars at the risk-free rate code snippet for code snippet years. Cash outflow code snippet at t equals 0, then code snippet lent. Net cash flow at t equals 0. 0. Cash flows at time t maturity. 1. From buying the forward, you are obligated to buy the asset. You pay code snippet for it. Cash outflow code snippet. 2. From replicating short forward, the loan matures and you receive code snippet. Cash inflow code snippet. You are obligated to buy back the asset to close your short position. You use the asset received from the forward contract to cover your short sale. Total profit at time t. Code snippet. Since code snippet, this profit is positive and risk-free. Let's illustrate with a numerical example. Spot price, S, equals $100. Risk-free rate, R, equals 5%, 0.05. Time to maturity, T, equals 1 year. Theoretical forward price, code snippet, equals $100 E carat, 0.051, equals $105.13. Market forward price, code snippet, equals $102 underpriced. Download the code on OnePageCode Substack. The positive profit of $3.13 again confirms the arbitrage opportunity. These examples clearly demonstrate how deviations from the no-arbitrage price create risk-free profit opportunities, which in turn drive market prices back to equilibrium. Theoretical versus real-world prices. While the no-arbitrage principle provides a powerful theoretical framework for pricing forward contracts, it's important to acknowledge that actual market prices may exhibit minor deviations from the pure theoretical value due to real-world market imperfections. Transaction costs, brokerage fees, bid-ask spreads, and other costs associated with buying/selling the underlying asset or entering the forward contract can eat into potential arbitrage profits, making small deviations unprofitable to exploit. Liquidity. In less liquid markets, it might be difficult to execute large trades at theoretical prices without impacting the market, thus limiting arbitrage opportunities. Borrowing/lending rate differences. Financial institutions typically lend at a higher rate than they borrow, violating the assumption of a single risk-free rate. Short selling constraints. It might not always be possible or cost-free to short sell certain assets, especially for retail investors or illiquid securities. Dividends and storage costs. For assets that pay dividends or incur storage costs, the forward pricing formula needs to be adjusted. For instance, for an asset paying a continuous dividend yield code snippet, the formula becomes code snippet. For commodities with storage costs, these costs would be added to the exponent. Despite these real-world nuances, the no-arbitrage model remains incredibly valuable as a benchmark for fair value and a tool for identifying significant mispricings. Visualizing forward price dynamics. The forward price code snippet is a function of the spot price code snippet, the risk-free rate code snippet, and the time to maturity code snippet. Assuming code snippet is constant for this 6. Visualization, we can observe how code snippet changes with variations in code snippet and code snippet. We'll use code snippet to plot these relationships. Download the code on one patch code Substack. This plot demonstrates that as the time to maturity code snippet increases, the theoretical forward price also increases. This is because the cost of financing the underlying asset, borrowing to buy it today, accumulates over a longer period, resulting in a higher future delivery price. Download the code on one patch code Substack. This second plot illustrates that a higher risk-free rate code snippet leads to a higher theoretical forward price. A higher interest rate means a greater cost of carrying the underlying asset over time, which must be reflected in the future delivery price. These visualizations provide an intuitive understanding of how the key parameters influence the theoretical forward price, reinforcing the quantitative relationships derived from the no-arbitrage principle. Pricing futures contract. The pricing of futures contracts builds upon the fundamental no-arbitrage principle introduced in the context of forward contracts. While forward contracts typically involve only the time value of money, futures contracts, especially for physical commodities, introduce additional factors known as the cost of carry. Understanding these components is crucial for determining the theoretical fair price of a futures contract. The cost of carry model. The cost of carry refers to the net cost of holding an underlying asset for a period of time. For a futures contract, the fair price should reflect the spot price of the asset plus the cost of carrying that asset until the futures contract's expiration. This cost of carry can be positive, a net cost, or negative, a net benefit. The primary components of the cost of carry are 1. Interest cost, or financing cost. This is the cost of borrowing money to purchase the underlying asset in the spot market and hold it until the future's expiration. Alternatively, it's the opportunity cost of capital if you use your own funds. 2. Storage costs, expenses incurred for storing a physical asset. 3. Convenience yield, a benefit derived from holding the physical asset, often related to its scarcity or immediate utility. Storage costs. Storage costs, code snippet, are expenses directly associated with holding a physical asset over time. These costs are added to the spot price because they represent an additional outlay for the holder of the physical asset. Detailed explanation of storage costs. For many physical commodities, holding the asset requires significant logistical and financial resources. These costs can include warehousing fees, rent for storage facilities, insurance premiums to protect against loss, damage, or theft, spoilage or deterioration. For perishable goods, this can be a significant cost in terms of lost quantity or quality. Transportation costs, if the asset needs to be moved between storage locations. Security costs, for high-value goods like gold or diamonds. Storage costs are typically expressed as an annualized percentage of the spot price of the underlying asset, or sometimes as a fixed cost per unit of the asset. When expressed as a fixed cost per unit, it needs to be converted into a percentage of the spot price for inclusion in the standard futures pricing formula. For instance, if storing 1 barrel of oil costs 10 cents per month and the spot price is $80 per barrel, the annualized storage cost is $1.20 per barrel, which is 1.5% of the spot price. Practical estimation of storage costs. Estimating storage costs in real-world markets often involves consulting industry data. Many industries publish standard storage rates. Looking at exchange-specific rules. For exchange-traded commodities, the exchange might define acceptable storage facilities and associated costs. Direct negotiation. For large quantities, storage fees might be negotiated with warehouse providers. Code example. Calculating storage cost component. Let's begin by defining a function to calculate the storage cost component, assuming it's given as an annualized percentage of the spot price. Download the code on OnePageCode Substack. This function code snippet computes the total storage cost over the contract's duration. While in a continuous compounding model, this is directly integrated into the exponent. For clarity in building up the discrete model, we represent it as a total cost that would be added to the spot price before compounding. Convenience yield. Convenience yield, code snippet, is the benefit or value derived from physically holding an underlying asset. This yield is subtracted from the spot price when calculating the futures price because it represents a benefit that the holder of the physical asset receives, but the holder of the futures contract does not. Detailed explanation of convenience yield. Convenience yield arises when there is a scarcity of the physical commodity or when having immediate access to the commodity provides a strategic advantage. It's an implicit return that accrues to the owner of the physical asset. Examples of convenience yield. Manufacturing. A refiner might hold crude oil inventory even if the futures price is lower, because having immediate access allows them to continue production without interruption, avoid supply chain risks, or take advantage of sudden spikes in demand for refined products. SAS. Ownal commodities. For agricultural products, holding inventory might be crucial to meet demand outside of harvest season. Precious metals. Sometimes while gold is often seen as having zero convenience yield, it just sits there. In times of extreme market stress or physical delivery concerns, a convenience yield can emerge. Equity index futures. For equity index futures, the dividend yield paid by the underlying stocks acts as a form of convenience yield. If you own the stocks, you receive dividends. If you only hold the futures, you do not. Therefore, the dividend yield is subtracted from the futures price calculation. Unlike interest rates or storage costs, convenience yield is not directly observable or easily quantifiable. It is often implied from the difference between the theoretical futures price, calculated using only interest and storage, and the actual market futures price. When futures prices are significantly below the spot price, a situation known as backwardation, it often implies a high convenience yield. Code example. Calculating convenience yield component. Similar to storage costs, let's define a function for the convenience yield component. Download the code on OnePageCode Substack. This code snippet function computes the total benefit gained from holding the physical asset over the contract's duration. This value will effectively reduce the cost of carry. Formal derivation of the futures pricing formula, no-arbitrage argument. The theoretical air price of a futures contract can be derived using the no-arbitrage principle, similar to forward contracts. The core idea is that in an efficient market, it should not be possible to make a risk-free profit by simultaneously buying and selling the same or equivalent assets. Let's assume code snippet. Current spot price of the underlying asset. Code snippet. Futures price. Code snippet. Risk-free interest rate. Annualized, continuously compounded for simplicity in derivation. Code snippet. Time to expiration of the futures contract in years. Code snippet. Annualized storage cost as a percentage of the spot price, continuously compounded. Code snippet. Annualized convenience yield as a percentage of the spot price, continuously compounded. Consider two portfolios at time code snippet. Portfolio A. 1. Buy 1 unit of the underlying asset in the spot market for code snippet. 2. Store the asset until time code snippet, incurring storage costs code snippet. 3. Receive convenience yield code snippet from holding the asset. 4. Finance the purchase of the asset and cover storage costs by borrowing code snippet at the risk-free rate code snippet. Portfolio B. 1. Take a long position in one futures contract expiring at time code snippet. At time code snippet, the value of the underlying asset will be code snippet. Analyzing portfolio A at expiration time T. If you buy the asset and hold it. Initial cost, code snippet. Financing cost, code snippet, cost of borrowing. Code snippet at rate code snippet for time code snippet. Storage costs. The future value of continuous storage costs over time code snippet will be code snippet. More precisely, it's code snippet if code snippet is a continuous rate applied to the spot price, or simply code snippet if code snippet is a simple rate. For the standard formula, code snippet is integrated into the exponent. For continuous rates, the net effect on the asset's value from code snippet and code snippet is code snippet. Convenience yield. This is a benefit, effectively reducing the net cost of holding. Its future value will be code snippet. The total cost of establishing and holding portfolio A until time code snippet, including financing, storage, and accounting for convenience yield, is equivalent to having invested code snippet initially, and then having that investment grow at a rate of code snippet. Thus, the value of portfolio A at time code snippet is code snippet, assuming code snippet are continuously compounded rates. Analyzing portfolio B at expiration time T. If you take a long position in a futures contract, at expiration, the value of the futures contract is code snippet, where code snippet is the futures price agreed upon at code snippet. There is no initial cost for entering a futures contract. Margin is a good faith deposit, not a cost of purchase. The no-arbitrage condition. To prevent arbitrage, the cost of acquiring the underlying asset teach. Rough the spot market and holding it, portfolio, must be equal to the cost of acquiring it through a futures contract, portfolio B, if the futures contract is settled by physical delivery. More generally, the future value of the spot asset plus carry costs must equal the futures price. Therefore, at time code snippet. This is the standard formula for pricing a futures contract with continuously compounded rates. If rates are discretely compounded annually, the formula becomes code snippet. This simplified form assumes code snippet and code snippet are also annual rates added/subtracted directly. More accurately, code snippet or similar, but the code snippet form is a common approximation for discrete rates when code snippet and code snippet are small percentages of spot. For robustness and common financial practice, we will primarily use the continuously compounded version, as it's more mathematically consistent for rates and yields. Futures pricing formula, continuously compounded. The most commonly used formula in financial modeling for pricing futures contracts, especially when considering continuous compounding, is $F equals S\E_R plus SC T $, where code snippet equals theoretical fair futures price. Code snippet equals current spot price of the underlying asset. Code snippet equals Euler's number, approximately 2.71828. Code snippet equals annualized risk-free interest rate, continuously compounded, as a decimal. Code snippet equals annualized storage cost, continuo, usly compounded, as a decimal. Code snippet equals annualized convenience yield, continuously compounded, as a decimal. Code snippet equals time to expiration of the futures contract, in years. Code example. Implementing the futures pricing formula. Let's implement this formula in Python. Download the code on OnePageCode Substack. This code snippet function takes the spot price, risk-free rate, time to expiration, and optional storage cost and convenience yield as inputs. It then computes the exponent code snippet and applies it to the spot price using code snippet to get the theoretical futures price. Numerical example, crude oil futures. Let's use a hypothetical example for crude oil futures. Spot price, $80 per barrel. Risk-free interest rate, are 3% per annum, 0.03. Time to expiration, T6 months, 0.5 years. Annualized storage cost, S1.5% per annum, 0.015. Annualized convenience yield, C 0.5% per annum, 0.005. Now, let's use our Python function to calculate the fair price. Download the code on OnePageCode Substack. Running this code will output the calculated theoretical futures price for crude oil based on the provided parameters. The output will be approximately $81.61. This result makes intuitive sense. The spot price is $80, and the net cost of carry, interest plus storage convenience yield, is positive, so the futures price should be higher than the spot price. Theoretical fair price versus actual market price. It is crucial to understand that the price derived from the cost of carry model is a theoretical fair price. This is the price that would prevail in an efficient market with no arbitrage opportunities and perfect information. However, the actual market price of a futures contract is determined by the forces of supply and demand on the exchange, deviations, and arbitrage opportunities. While theoretical and market prices tend to converge, especially for highly liquid contracts, deviations can occur due to market sentiment, investor expectations, and speculation, supply and demand imbalances, sudden shifts in the availability or demand for the underlying asset, liquidity. Less liquid markets may exhibit larger deviations, transaction costs, brokerage fees, bid-ask spreads, and margin requirements can make small arbitrage opportunities unprofitable. Borrowing/lending rates. Actual rates available to market participants might differ from the assumed risk-free rate. When a market price significantly deviates from the theoretical fair price, arbitrageurs may step in to exploit these mispricings, thereby pushing the market price back towards the theoretical value. Arbitrage strategy example. Let code snippet be the actual market futures price, and code snippet be our calculated fair price. 1. If code snippet, futures are overpriced. Strategy. Sell short the futures contract and simultaneously buy the underlying asset in the spot market. Hold the asset until the futures expiration. Profit. At expiration you deliver the asset, or cash settle, at the higher futures price code snippet, while your actual cost of acquiring and holding the asset was code snippet. The difference, code snippet, is your risk-free profit less transaction costs. 2. If code snippet, futures are underpriced. Strategy, buy long the futures contract and simultaneously short sell the underlying asset in the spot market. Invest the proceeds from the short sale at the risk-free rate until the futures expiration. Profit. At expiration, you take delivery of the asset at the lower futures price code snippet, which you then use to cover your short position. Your effective cost was code snippet, but you theoretically should have paid code snippet. The difference, code snippet, is your risk-free profit less transaction costs and assuming short selling is feasible. Code example. Comparing theoretical versus market price. Download the code on OnePageCode Substack. The code snippet function helps identify if the market price deviates sufficiently from the theoretical price to warrant an arbitrage strategy, taking into account a code snippet for transaction costs. Sensitivity analysis. Understanding how changes in input parameters affect the futures price is crucial for traders and risk managers. This is known as sensitivity analysis. We can programmatically vary one input at a time while keeping others constant to observe its impact. Code example. Sensitivity to spot price. Let's examine how the futures price C hangs with variations in the spot price. Download the code on OnePageCode Substack. This code block generates a range of spot prices and calculates the corresponding theoretical futures prices. The resulting plot clearly shows a linear relationship. As the spot price increases, the futures price increases proportionally. This is expected, as the futures price is directly proportional to the spot price. Code example. Sensitivity to time to expiration. Next, let's see how the futures price responds to changes in the time to expiration. Download the code on OnePageCode Substack. This plot illustrates that as time to expiration increases, the futures price also increases, assuming a positive net cost of carry, code snippet. This is because the longer the period, the more time the cost of carry has to accumulate. Code example: sensitivity to interest rate. Let's analyze the impact of changes in the risk-free interest rate. Download the code on OnePageCode Substack. As the risk-free interest rate increases, the cost of financing the underlying asset increases, leading to a higher theoretical futures price. Code example: sensitivity to storage cost and convenience yield. Finally, let's examine the effects of storage cost and convenience yield. Download the code on OnePageCode Substack. The plot for storage costs shows that higher storage costs lead to higher futures prices as they increase the cost of holding the underlying asset. Conversely, the plot for convenience yield shows that higher convenience yields lead to lower futures prices as the benefit of holding the physical asset reduces the effective cost of carry. Real-world applications and market phenomena. The cost of carry model is broadly applicable across various asset classes, though the specific components, code snippet and code snippet, vary. Commodity futures, e.g., crude oil, grains, metals, these are prime examples where storage costs and convenience yields are highly relevant. Oil futures, for instance, are heavily influenced by the cost of storing crude in tanks and the convenience yield of having immediate access to physical supply for refineries. Equity index futures, e.g., S&P 500 futures, for these, code snippet, storage cost, is typically zero. The code snippet, convenience yield, is replaced by the dividend yield of the underlying index. If you hold the stocks in the index, you receive dividends. If you hold the futures, you do not. Thus, the dividend yield effectively reduces the futures price relative to the spot index. The formula becomes code snippet, where code snippet is the dividend yield. Currency futures. For currency futures, the cost of carry is primarily driven by the interest rate differential between the two currencies involved. If code snippet is the foreign risk-free rate and code snippet is the domestic risk-free rate, the formula is approximately code snippet. Here, code snippet acts conceptually like a convenience yield benefit of holding for IGN currency assets, and code snippet acts like the financing cost. Bond futures/interest rate futures. These are more complex, as the underlying is a notional bond or an interest rate, and there are concepts like cheapest to deliver bonds. However, the underlying principle still relates to the cost of financing the underlying asset, or its equivalent, until the future's expiration. Contango and backwardation. The relationship between the spot price and the futures price is often described using two key terms. Contango, a market condition where the futures price is higher than the spot price, code snippet. This is the normal state when the net cost of carry, code snippet, is positive. It implies that holding the asset incurs a net cost, financing plus storage, convenience yield. Backwardation, a market condition where the futures price is lower than the spot price, code snippet. This occurs when the net cost of carry is negative, typically driven by a high convenience yield, i.e., code snippet. This often happens when there is a current shortage of the physical commodity, making immediate access, and thus holding the physical asset, particularly valuable. Understanding contango and backwardation is vital for commodity traders and hedgers, as it provides insights into market expectations about future supply and demand conditions for the physical asset. Contango and backwardation. Futures prices do not always mirror spot prices directly. Instead, their relationship, particularly across different maturities, reveals crucial information about market expectations, supply and demand dynamics, and the costs associated with holding an underlying asset. This relationship is often visualized through a futures price curve, also known as the term structure of futures prices. The futures price curve. The futures price curve is a graphical representation that plots the prices of futures contracts for a specific underlying asset against their respective expiration dates or times to maturity. The y-axis typically represents the futures price. The x-axis represents the time to maturity, e.g., 1 month, 3 months, 6 months, 1 year, etc., or the specific expiration date. The shape of this curve indicates whether the market is in code snippet or code snippet. Understanding these two states is fundamental for interpreting market sentiment, assessing risk, and formulating effective trading and hedging strategies. Let's begin by setting up a basic plotting environment in Python, which we will use to visualize these curves. Download the code on OnePageCode Substack. This initial setup imports necessary libraries: code snippet for plotting, code snippet for numerical operations, and code snippet for potential data handling, though not strictly necessary for simple curves. We also set a code snippet style for better aesthetics in our visualizations. Contango. A market is said to be in contango when the futures price is higher than the current spot price, or when longer-dated futures contracts are more expensive than shorter-dated ones. Visually, a futures curve in contango slopes upwards, implying that the market expects prices to be higher in the future. Characteristics of a contango market. 1. Upward sloping curve. Futures prices increase with increasing time to maturity. 2. Futures price, spot price. For any given maturity, the futures price is generally above the current spot price, assuming a non-zero time to maturity. Drivers of contango, the cost of carry model. The most common reason for a market to be in contango, especially for storable commodities and financial assets, is the cost of carry. As discussed in previous sections, the theoretical no-arbitrage futures price, code snippet, is determined by the spot price, code snippet, plus the cost of holding the asset until the future's expiration. The cost of carry model is expressed as code snippet, where code snippet equals futures price, code snippet equals current spot price, code snippet equals Euler's number, base of a natural logarithm, code snippet equals risk-free interest rate, cost of financing the asset, code snippet equals storage costs, e.g., warehousing, insurance, spoilage, transportation, as a percentage of the asset value per year. Code snippet equals convenience yield, benefit of holding the physical asset, as a percentage of the asset value per year. Code snippet equals time to maturity in years. In a contango market, the combined effect of the risk-free rate, code snippet, and storage costs, code snippet, outweighs any convenience yield, code snippet. Since code snippet is typically positive and code snippet is often positive for physical commodities, it costs money to store oil, gold, grain, etc. These factors naturally push futures prices above the spot price. Let's demonstrate this with a numerical example and then visualize it using Python. Numerical example: contango due to storage costs. Assume current spot price, code snippet, equals $100. Risk-free rate, code snippet, equals 3% per annum, 0.03. Annual storage costs, code snippet, equals 2% per annum, 0.02. Convenience yield, code snippet, equals 0% per annum, 0.00. Let's calculate futures prices for different maturities. 3-month futures, T equals 0.25 years. Code snippet. 6-month futures, T equals 0.50 years. Code snippet. As you can see, as time to maturity increases, the futures price also increases, demonstrating contango. Code example: plotting a theoretical contango curve. First, let's define a function to calculate the theoretical futures price based on the cost of carry model. Download the code on OnePageCode Substack. This code snippet function encapsulates the cost of carry formula. It takes all the necessary parameters and returns the futures price for a given maturity. This modular approach makes our code cleaner and easier to reuse. Now, let's use this function to generate 8 data points for a contango curve and plot it. Download the code on OnePageCode Substack. Here, we define the parameters for our contango scenario, similar to our numerical example. We then create an array of code snippet ranging from 1 to 12 months, converted to years, and use a list comprehension to calculate the corresponding futures price for each maturity using our function. Finally, we plot the generated futures curve. Download the code on OnePageCode Substack. This code block generates the plot. We use code snippet to draw the curve, code snippet to show the spot price reference, and add appropriate labels, title, and a legend for clarity. The upward slope clearly illustrates contango. Other factors contributing to contango. While cost of carry is primary, Market expectations can also influence Contango. If market participants broadly expect the spot price of an asset to rise significantly in the future, e.g., due to anticipated supply shortages or increased demand, they might bid up futures prices, reinforcing a Contango structure. Backwardation. Conversely, a market is in backwardation when the futures price is lower than the current spot price, or when longer-dated futures contracts are cheaper than shorter-dated ones. Visually, a futures curve in backwardation slopes downwards, implying that the market expects prices to be lower in the future. Characteristics of a backwardation market. 1. Downward sloping curve. Futures prices decrease with increasing IME to maturity. 2. Futures price, spot price. For any given maturity, the futures price is generally below the current spot price, excluding the very short term where convergence is dominant. Drivers of backwardation. Convenience yield. The primary driver of backwardation, especially prominent in commodity markets, is a significant convenience yield, code snippet. The convenience yield represents the non-monetary benefit or value derived from holding the physical asset rather than a futures contract or synthetic position. Think of it as the value of immediate availability. If a physical commodity is scarce or there's an immediate high demand, holding the physical asset provides a premium that futures contracts cannot. Examples of convenience yield. Crude oil. During a period of tight supply, refiners might pay a premium for immediate access to crude oil to keep their operations running, even if futures prices for later delivery are lower. Avoiding a costly shutdown or fulfilling immediate contractual obligations offers significant value. Natural gas. In winter, if an unexpected cold snap causes a surge in heating demand, the immediate availability of natural gas can be highly valued, leading to backwardation. Agricultural commodities. Just before a harvest, the existing supply might be tight, leading to a high spot price. However, once the harvest arrives, supply increases, and futures prices for post-harvest delivery might be lower, causing backwardation. When the convenience yield, code snippet, is high enough to offset the risk-free rate, code snippet, and storage costs, code snippet, i.e., code snippet, the cost of carry becomes negative, pushing futures prices below the spot price and resulting in backwardation. Numerical example. Backwardation due to convenience yield. Assume current spot price, code snippet, equals $100. Risk-free rate, code snippet, equals 3% per annum, 0.03. Annual storage costs, code snippet, equals 1% per annum, 0.01. Annual convenience yield, code snippet, equals 6% per annum, 0.06. Let's calculate futures prices for different maturities. 3-month futures, T equals 0.25 years. Code snippet. 6-month futures, T equals 0.50 years. Code snippet. In this scenario, as time to maturity increases, the futures price decreases, demonstrating backwardation. Code example. Plotting a theoretical backwardation curve. We will reuse our code snippet function and define parameters for a backwardation scenario. Download the code on OnePageCode Substack. Similar to the Contango example, we set the parameters, crucially setting a high code snippet, to induce backwardation. We then calculate the futures prices. Now, let's plot the backwardation curve. Download the code on OnePageCode Substack. This plot illustrates a downward sloping curve, characteristic of backwardation. Notice how the futures prices are below the spot price for most maturities, especially further out. Other factors contributing to backwardation. Inconvenience yield is the primary driver. Strong market expectations of falling prices, e.g., anticipation of oversupply or reduced demand, can also contribute to a backwardated market structure. Normal contango and normal backwardation. The hedging perspective. The terms code snippet and code snippet were introduced by John Maynard Keynes and John Hicks, focusing on the risk premium required by speculators to take on the risk of hedgers. These concepts relate to the relationship between futures prices and the expected future spot price at maturity, rather than just the current spot price. Normal contango. occurs when futures prices are generally below the expected future spot price. This situation arises when producers, e.g., farmers, oil companies, are the primary hedgers, selling futures to lock in prices for their output. Their collective selling pressure drives futures prices lower than what speculators expect the future spot price to be. Speculators who take the long side of these contracts are compensated with a code snippet, the difference between the expected future spot price and the current futures price, for bearing the price risk that hedgers want to shed. In a normal contango market, a long futures position typically experiences a negative code snippet. Normal backwardation occurs when futures prices are generally above the expected future spot price. This happens when consumers or industrial users, e.g., airlines hedging fuel, are the primary hedgers, ing futures to lock in their input costs. Their collective buying pressure drives futures prices higher than what speculators expect the future spot price to be. Speculators who take the short side of these contracts are compensated with a risk premium. In a normal backwardation market, a long futures position typically experiences a positive code snippet. It's important to distinguish between contango/backwardation, which describes the relationship between futures prices and the current spot price, or between different futures maturities, and normal contango/backwardation, which describes the relationship between futures prices and the expected future spot price. While often related, they're not strictly equivalent. A market can be in contango, but not normal contango, if the futures price is above the expected future spot price. Implications for market participants. The roll yield. The shape of the futures curve has significant implications for traders and investors, particularly those holding positions across multiple contract expirations. This leads to the concept of roll yield. Roll yield refers to the profit or loss generated when an investor rolls a futures position from a near-term contract to a further-term contract. This is a common practice for investors aiming for continuous exposure to an underlying asset. In a contango market, when rolling a long position from an expiring contract, which is cheaper, to a new, longer-dated contract, which is more expensive, the investor effectively sells low and buys high. This results in a negative roll yield. Over time, repeatedly rolling a long position in a contango market can erode returns. In a backwardation market, when rolling a long position from an expiring contract, which is more expensive, to a new, longer-dated contract, which is cheaper, the investor sells high and buys low. This results in a positive roll yield. Continuously rolling a long position in a backwardated market can enhance returns. Let's illustrate the concept of roll yield with a simplified simulation. Download the code on OnePageCode Substack. This code snippet function provides a conceptual demonstration. For simplicity, it assumes that the price of the expiring contract is equal to the current spot price, reflecting the convergence at expiration. It then calculates the price of a new contract using our code snippet function and sums the profit or loss from each roll. Let's run this simulation for both a contango and a backwardation scenario. Download the code on OnePageCode Substack. The output of these simulations clearly shows a negative total roll P&L in contango due to buying the more expensive longer-dated contract, and a positive total roll P&L in backwardation due to buying the cheaper longer-dated contract. Convergence of futures prices to spot prices. A fundamental principle of futures markets is that as a futures contract approaches its expiration date, its price will converge to the UND. Early spot price. This convergence is driven by arbitrage forces. If the futures price were significantly different from the spot price just before expiration, an arbitrageur could simultaneously buy the cheaper asset, spot or futures, and sell the more expensive one, guaranteeing a risk-free profit. This activity would quickly bring the two prices into alignment. At expiration, code snippet. The cost of carry formula simplifies. Code snippet. This confirms that the futures price must equal the spot price at expiration. Let's simulate this convergence over time. Download the code on OnePageCode Substack. The code snippet function models a simplified linear convergence. It takes in code snippet price, and the code snippet, It then calculates the futures price for each day, progressively moving it from the initial futures price towards the spot price. Now, let's plot this convergence for both Contango and backwardation scenarios. Download the code on OnePageCode Substack. Here, we set up two convergence scenarios. We calculate an initial futures price for a 30-day maturity for both Contango and backwardation using our code snippet function. Then, we call code snippet to get the price paths. Finally, we plot the convergence. Download the code on OnePageCode Substack. This plot visually confirms the convergence. Regardless of whether the market starts in Contango or backwardation, the futures price moves towards and ultimately meets the spot price. As the contract approaches its final expiration, real-world examples and practical applications. Understanding Contango and backwardation is not just theoretical. It has profound implications for various market participants. Commodity producers, e.g., oil companies, farmers, these entities are often code snippet the commodity. They produce it. In Contango, they might prefer to store their commodity and sell it in the futures market at a higher price for later delivery, effectively locking in a profit above the current spot price. However, if they hedge by selling futures and the market is in normal Contango, they might miss out on potential future spot price increases, as the futures price is below the expected future spot. In backwardation, the spot price is higher than futures prices. This incentivizes immediate sale of the physical commodity to capture the higher spot price. Hedging by selling futures in backwardation might mean locking in a lower price than the current spot, but still provides price certainty. Commodity consumers, e.g., airlines, manufacturers, these entities are often code snippet the commodity. They need to buy it. In Contango, buying futures means locking in a price higher than the current spot. If they need continuous supply, the negative roll yield can be a significant cost. In backwardation, buying futures means locking in a price lower than the current spot. This is generally favorable for consumers, and the positive roll yield can be a bonus for long positions, speculators, and traders. Calendar spreads. Traders can exploit differences in futures prices across maturities by simultaneously buying one maturity and selling another. For example, in a steep Contango, a trader might sell the near-month contract and buy a far-month contract, betting that the spread will narrow. Trend following. Backwardation often signals tight supply and strong immediate demand, which can be bullish for spot prices. Contango, especially steep Contango, can indicate oversupply. Roll yield harvesting. Investors in commodity indices, which often maintain continuous exposure by rolling contracts, are significantly impacted by roll yield. A persistent backwardation can lead to substantial positive returns from rolling, while persistent Contango can lead to significant drag on performance. Specific examples. Crude oil, WTI, Brent frequently exhibits Contango due to significant storage costs and relatively stable supply. However, during periods of geopolitical tension or supply disruptions, it can flip into backwardation. Natural gas, highly seasonal and sensitive to weather events, often exhibits backwardation during peak winter demand or summer heat waves due to immediate demand outstripping supply. Gold, typically in Contango, driven by interest rates, financing cost of holding gold, and storage costs. Convenience yield for gold is generally low. Agricultural commodities, e.g., corn, wheat, often show backwardation arrow. UNE harvest time, where immediate supply is tight, but futures prices for post-harvest delivery are lower due to anticipated increased supply. In summary, Contango and backwardation are not just theoretical constructs. They are observable market phenomena that reflect the interplay of cost of carry, convenience yield, and market expectations. Interpreting the futures curve provides invaluable insights into the health and dynamics of an underlying market. Working with futures data. Acquiring and visualizing historical financial data is a fundamental skill for any quantitative trader or financial analyst. While theoretical models provide a framework for understanding futures contracts, real-world data allows us to observe market behavior, test hypotheses, and develop trading strategies. This section bridges the gap between theory and practice by demonstrating how to programmatically retrieve and visualize historical futures contract data using Python's powerful libraries: Code Snippet, and Code Snippet. 1. Acquiring historical futures data. To begin any quantitative analysis, the first step is to obtain reliable data. For historical futures prices, various data providers exist, but for illustrative and educational purposes, Code Snippet offers a convenient way to access data readily available through Yahoo Finance. 1.1. Setting up the environment and initial imports. Before we can download any data, we need to import the necessary Python libraries. We'll use Code Snippet for data manipulation, Code Snippet for data downloading, and Code Snippet for plotting. It's also good practice to set up some default plotting styles for better aesthetics. Download the code on OnePageCode Substack. The first step is always to import the required libraries. Code Snippet is indispensable for handling tabular data. Code Snippet simplifies the process of fetching financial data, and Code Snippet is our tool for visualization. The Code Snippet command is specific to Jupyter environments, ensuring plots appear directly in the notebook. Code Snippet sets a consistent visual theme for our plots, improving their readability and appearance. 1.2. Downloading single futures contract data. Futures contracts are typically identified by specific ticker symbols. For continuous futures contracts on Yahoo Finance, these often end with Code Snippet. For example, Platinum futures are Code Snippet, Gold futures are Code Snippet, and Copper futures are Code Snippet. We can use the Code Snippet function to retrieve historical data for a specified ticker and date range. Download the code on OnePageCode Substack. Here, we specify the code snippet and the desired code snippet and code snippet. The code snippet function fetches the data, returning it as a pandas data frame. We then use code snippet to see the initial rows and code snippet to get a summary of the data frame structure, including data types and non-null counts. This is crucial for understanding the raw data we're working with. Notice the code snippet column is the data frame's index. 1.3. Converting the index to datetime objects. For time series analysis and plotting, it's critical that the data frame's index is a proper code snippet object. While code snippet often returns an index that pandas recognizes as a code snippet type, sometimes it might be in code snippet type string. Explicitly converting it ensures that time-based operations and plotting functio and work correctly. Download the code on OnePageCode Substack. The code snippet function converts the existing index to a code snippet data type. This enables code snippet and code snippet plotting functions to correctly interpret the time axis, allowing for proper scaling, tick formatting, and handling of time gaps, e.g., weekends or holidays. If the index were a simple string or object type, code snippet would treat it as categorical data, leading to incorrect or uninformative plots. The code snippet argument is a robust way to handle potential malformed date strings, converting them to code snippet, not a time, rather than raising an error. 1.4. Initial data inspection and common parameters. Before diving into visualization, it's often useful to get a statistical summary of your data and understand other common code snippet parameters. Download the code on OnePageCode Substack. Code Snippet provides a quick statistical summary, which is invaluable for understanding the range, mean, and standard deviation of your price data. Checking for Code Snippet helps identify any gaps in the data, a common issue in financial time series. While we don't implement full missing data handling here, Code Snippet and Code Snippet are common pandas methods for this. The Code Snippet parameter in Code Snippet is powerful for adjusting the granularity of your data, e.g., daily, weekly, monthly. A note on ADJ close versus close for futures. For equities, ADJ close typically adjusts for C. Operate actions like stock splits and dividends, providing a more accurate historical price representation for total return calculations. For futures contracts, which typically do not pay dividends or undergo stock splits in the same way, the ADJ close and close prices are often identical. However, Some data providers might apply minor adjustments to ADJ close for continuous future series to smooth out rollover effects. For most basic analysis of futures prices, using close is perfectly acceptable and often preferred as it represents the official settlement price. We will use ADJ close for single plots and close when comparing multiple series, illustrating that both are generally viable for futures. 2. Visualizing single futures contract prices. Once the data is acquired and properly formatted, the next step is to visualize it. A simple line plot of the closing price over time is usually the first visualization to create. This allows us to quickly observe trends, volatility, and significant price movements. 2.1 Basic plot setup and data selection. To ensure our plot is clear and readable, we'll specify its size and select the specific column we want to visualize. In this case, the ADJ close price. Download the code on OnePageCode Substack. Code snippet creates a new plot figure with a specific size, which is important for presentation and readability. We then select the code snippet column from our data frame, which contains the daily closing prices for PL. Addendum futures. 2.2 Plotting and customizing a single series. Pandas data frames have a convenient built-in code snippet method that integrates directly with Matplotlib. We can then use code snippet functions to add titles, axis labels, and a legend for clarity. Download the code on OnePageCode Substack. The code snippet method quickly generates a line chart. We then use code snippet to add descriptive text. Code snippet and code snippet allow us to control the appearance of the axis ticks and their labels. Code snippet displays the label we provided in the code snippet call, and code snippet allows us to control its font size. Code snippet automatically adjusts plot parameters for a tight layout, and code snippet displays the plot. 2.3 Saving the generated plot. For reports or presentations, it's often necessary to save the generated plots to image files. Code snippet provides a straightforward way to do this using code snippet. Download the code on OnePageCode Substack. The code snippet function allows you to save the currently active figure to a specified file path. You can choose various formats like PNG, JPEG, PDF, or SVG by simply changing the file extension. The code snippet parameter controls the resolution, which is important for print quality. 3. Working with multiple futures contracts. Comparing the price movements of different futures contracts can reveal insights into intermarket relationships, correlations, or potential arbitrage. Opportunities. Code snippet can download data from multiple tickers simultaneously, and code snippet handles the resulting multi-level data frame efficiently. 3.1 Downloading data from multiple tickers. When downloading data from multiple tickers, code snippet can group the columns by ticker, resulting in a multi-level column index. This structure is powerful for selecting data for specific symbols and attributes. Download the code on OnePageCode Substack. By passing a list of tickers to code snippet, we retrieve data for both gold and copper futures. The code snippet argument is crucial here. It organizes the data frame with a multi-level column index, where the top level is the ticker symbol and the second level contains the data attributes: open, high, close, etc. This structure is very common and efficient for handling multi-asset data in Pandas. 3.2 Inspecting a multi-level data frame. Understanding how to access data in a multi-level data frame is key. You can select specific columns using tuples or by chaining indexers. Download the code on OnePageCode Substack. The code snippet output confirms the multi-level index and data types. To access a specific column, like the close price for gold, you use code snippet. This two-step indexing allows precise selection within the hierarchical structure. 3.3 Index conversion from multiple data frames. Similar to single contracts, ensuring the index as a code snippet object is vital for plotting multiple time series correctly. Load the code on OnePageCode Substack. This step is identical to the single ticker conversion, ensuring that the shared index for all futures contracts is correctly interpreted as a time series by Matplotlib. 4. Advanced visualization, dual y-axes, and overlays. When comparing financial instruments with significantly different price scales, e.g., gold trading at thousands per ounce versus copper at a few dollars per pound, plotting them on a single y-axis can make one series appear flat. A secondary y-axis allows both series to be visualized effectively on their own scale. 4.1 Plotting with dual y-axes using Matplotlib's object-oriented interface. Matplotlib offers two main interfaces, code snippet, state-based, and object-oriented, explicitly creating code snippet and code snippet objects. For more complex plots, especially those involving multiple axes, the object-oriented approach provides greater control. Download the code on OnePageCode Substack. Here, we use code snippet to get a code snippet object, code snippet, and in code snippet object, code snippet. We plot gold on code snippet. Then, code snippet creates code snippet, a new axis object that shares the x-axis with code snippet but has its own independent y-axis. Copper is then plotted on code snippet. This object-oriented approach gives us granular control over each axis. 4.2 Customizing dual-axis plots and combining legends. Customizing titles, labels, and legends becomes slightly more involved with multi-PLE axes, as each axis has its own labels and potentially its own legend handles. Download the code on OnePageCode Substack. We set specific titles and y-axis labels for each code snippet object. To create a single legend for both plots, we retrieve the legend handles and label from both code snippet and code snippet using code snippet, concatenate them, and then pass the combined list to code snippet. This ensures a single, comprehensive legend for the entire plot. 4.3 Calculating and plotting daily returns. Beyond just prices, analyzing daily returns is crucial for understanding volatility and performance. Returns are typically calculated as the percentage change from one period to the next. Download the code on OnePageCode Substack. The code snippet method directly calculates the percentage change between consecutive rows. We then code snippet to remove the first code snippet value that results from this calculation. Plotting returns often reveals periods of high and low volatility more clearly than price plots. 4.4 Overlaying simple moving average, SMA. Moving averages are fundamental technical indicators used to smooth out price data and identify trends. A simple moving average, SMA, is the average of a security's price over a specified number of periods. Download the code on OnePageCode Substack. The code snippet method is a powerful pandas function for calculating rolling statistics like moving averages. Here, we calculate 20-day and 50-day SMAs and overlay the M on the gold futures price chart. This simple addition immediately provides visual insight into potential short-term and long-term trends. 5. Further applications and considerations. The ability to acquire, process, and visualize futures data programmatically forms the bedrock for more sophisticated quantitative analysis. Comparing percentage change. Instead of absolute prices, comparing the percentage change of two futures contracts over a period can reveal their relative performance and correlation, especially when their price levels are vastly different. This can be done by normalizing the series, e.g., dividing by the first value, or simply plotting their cumulative returns. Plotting volume data. Volume is a crucial indicator of market activity and liquidity. It can be plotted as a bar chart on a secondary y-axis below the price chart, often using code snippet or code snippet. High volume often accompanies significant price movements, confirming trends or signaling reversals. Future spreads. A future spread involves simultaneously buying one futures contract and selling another, typically for the same underlying commodity, but with different expiration dates or different but related commodities. For example, the crack spread, crude oil versus refined products, or crush spread, soybeans versus soy oil/meal. While code snippet primarily provides continuous futures, like GC equals F, obtaining specific contract month data, e.g., CLG23 NYM for a specific crude oil contra. CT often requires specialized data providers. Once acquired, plotting the difference between two contract prices is straightforward. Basis for backtesting. The data acquisition and visualization techniques demonstrated here are the initial steps for backtesting trading strategies. By obtaining historical data, you can then apply trading rules, e.g., by when 20-day SMA crosses above 50-day SMA, and simulate their performance over historical periods, evaluating profitability and risk. This forms the core of quantitative strategy development. This section has provided a practical foundation for working with futures data in Python, equipping you with essential skills for data acquisition, manipulation, and visualization, which are indispensable for any aspiring quant trader. Adding technical indicators. Technical indicators are mathematical calculations based on historical price, volume, or open interest data. They are commonly used by traders to forecast future price movements, identify market trends, gauge momentum, and assess volatility. While not foolproof, these indicators provide a structured way to analyze market behavior and can form the basis of quantitative trading strategies. In the context of futures contracts, technical indicators help traders interpret complex market dynamics, identify potential entry and exit points, and manage risk. This section will guide you through calculating and visualizing several popular technical indicators: Relative Strength Index, RSI, Bollinger Bands, and Moving Average Convergence Divergence, MACD, using Python's code snippet library and visualizing them with code snippet. Setting up your environment. Before we begin, ensure you have the necessary libraries installed. The code snippet library, technical analysis library, provides a convenient way to compute a wide range of indicators, while code snippet is used for data acquisition and code snippet for data manipulation. Code snippet will handle the plotting. If you haven't already, install them using code snippet. Download the code on OnePageCode Substack. Acquiring futures data. Our first step is to obtain historical price data for a futures contract. For this example, we will use the S&P 500 E-mini futures contract identified by the ticker code eSnippet on Yahoo Finance. We'll use the code snippet library to download the daily historical data for a specified period. Download the code on OnePageCode Substack. The code snippet function fetches the data. The code snippet parameter, though not explicitly set here, defaults to code snippet for daily data. Other common intervals include code snippet for hourly, code snippet for weekly, etc. It's crucial to select an interval appropriate for your analysis and trading strategy. For instance, high-frequency strategies might require minute-level data, while long-term trend analysis can use daily or weekly data. The output code snippet is a pandas data frame, where each row represents a trading day and columns include code snippet, code snippet, code snippet, code snippet, code snippet, and code snippet. Download the code on OnePageCode Substack. Calculating technical indicators. The code snippet library simplifies the computation of technical indicators. It's designed to be intuitive, allowing you to create indicator objects and then call methods to get the desired values. Relative Strength Index, RSI. Concept. The Relative Strength Index, RSI, is a momentum oscillator that measures the speed and change of price movements. It oscillates between 0 and 100 and is typically used to identify overbought or oversold conditions in an asset. An RSI reading above 70 generally suggests an asset is overbought, potentially signaling a reversal or pullback. Conversely, an RSI below W30 indicates an oversold condition, suggesting a potential rebound. Mathematical intuition. RSI is calculated based on the average gains and average losses over a specified period. The core formula is $RSI equals 100 \frac 101 plus RS dollar, where $RS equals \frac \text, average gain \text, average loss dollar. The average gain/loss is typically an exponential moving average, EMA, of positive/negative price changes. Code snippet library usage. To calculate RSI, we use code snippet. By default, it uses a 14-period lookback, which is the most common setting. You can change this by passing the code snippet parameter. Download the code on one patch code Substack. The code snippet method returns a pandas series containing the RSI values, which we then assign to a new column named code snippet in our data frame. Note that the first 13 values will be code snippet because the calculation requires 14 periods of data. We'll address handling code snippet values later. Download the code on one patch code Substack. Bollinger Bands. Concept. Bollinger Bands are a volatility indicator developed by John Bollinger. They consist of a simple moving average, SMA, and two standard deviation bands plotted above and below the SMA. The bands expand and contract with market volatility. They widen during periods of high volatility and narrow during periods of low volatility. Prices tend to stay within the bands, so price excursions beyond the bands can signal potential reversals or continuation of trends. Mathemati. Intuition. Middle band. End period simple moving average, SMA, of the closing price. Upper band. Middle band plus K end period standard deviation. Lower band. Middle band. K end period standard deviation. Commonly, N equals 20 and K equals 2, i.e., 20 period SMA and 2 standard deviations. Code snippet library usage. Use code snippet. The default code snippet is 20 periods and code snippet, 4 standard deviation multiplier, is 2. Download the code on one patch code Substack. Similar to RSI, the code snippet and code snippet methods return pandas series. The first 19 values will be code snippet due to the 20-period window. Download the code on one patch code Substack. Moving average convergence divergence, MACD. Concept. Moving average convergence divergence, MACD, is a trend-following momentum indicator that shows the relationship between two moving averages of a security's price. It is calculated by subtracting the 26-period exponential moving average, EMA, from the 12-period EMA. The result is the MACD line. A 9-period EMA of the MACD line, called the signal line, is then plotted on top of the MACD line, functioning as a trigger for buy and sell signals. Mathematical intuition. MACD line, 12-period EMA of close, 26-period EMA of close. Signal line, 9-period EMA of MACD line. MACD histogram. MACD line, signal line, often visualized as a bar chart. Code snippet library usage. Use code snippet. The default parameters are code snippet, and code snippet. Download the code on one patch code Substack. The code snippet and code snippet methods provide the respective lines. MACD calculations require a significant amount of historical data to initialize the EMAs, so the initial values will be code snippet for a longer period compared to RSI or Bollinger Bands. Download the code on one patch code Substack. Handling missing values, code snippet. As observed, technical indicator calculations often result in code snippet values at the beginning of the data frame because they require a certain number of preceding data points. It's good practice to drop these code snippet rows before plotting or further analysis to ensure calculations are based on complete data. Download the code on one patch code Substack. By using code snippet, we modify the data frame directly, removing any rows where at least one of the indicator columns has a code snippet value. This is important for consistent visualization and analysis. Download the code on one patch code Substack. Visualizing technical indicators. Visualizing technical indicators alongside price data is crucial for gaining insights into market conditions. We will create a multi-panel plot using code snippet to display the S&P 500 E-mini futures closing price, Bollinger Bands, RSI, and MACD in separate subplots, all sharing the same time, x-axis. Setting up the plot layout. We'll use code snippet to create a figure and a grid of subplots. The code snippet argument is important here. It ensures that all subplots share the same x-axis, time, allowing for synchronized scrolling and zooming across all panels, which is essential for time series analysis. Download the code on one patch code Substack. This sets up an empty plot canvas with 3 vertically stacked subplots. Plotting price and Bollinger Bands. The first subplot will show the code snippet price of the futures contract along with the calculated code snippet and code snippet. Download the code on one Code Substack. We plot the code snippet price as a solid blue line and the Bollinger Bands as dashed lines. Code snippet, code snippet, code snippet, and code snippet are used for clear labeling and readability. Plotting Relative Strength Index, RSI. The second subplot will display the RSI values. We'll also add horizontal lines at 30 and 70 to indicate oversold and overbought thresholds, respectively. Download the code on one Code Substack. The code snippet function is particularly useful for drawing horizontal reference lines, which are common for indicators like RSI. Plotting Moving Average Convergence Divergence, MACD. The third subplot will show the MACD line and its signal line. A horizontal line at 0 helps identify crossovers above or below the center line. Download the code on one Code Substack. Finally, to display the plot and optionally save it to a file, download the code on one Code Substack. The code snippet command renders the complete multi-panel plot. The code snippet command can be ED to export the plot to various image formats like PNG or JPEG, which is useful for reports or presentations. Code snippet ensures a high-resolution image, and code snippet prevents labels from being cut off. Interpreting signals from indicators. Understanding how to interpret the signals generated by these indicators is key to their practical application in trading. Relative Strength Index, RSI. Overbought/oversold. An RSI above 70 suggests the asset may be overbought and due for a correction or reversal. An RSI below 30 suggests the asset is oversold and may be due for a bounce. These are not direct buy-sell signals, but rather warnings of potential turning points. Divergence. If price makes a new high but RSI makes a lower high, bearish divergence. It can signal weakening momentum and a potential reversal. The opposite, bullish divergence, applies to lows. Bollinger Bands. Volatility. Narrow bands indicate low volatility, while wide bands suggest high volatility. Periods of low volatility often precede periods of high volatility and vice versa. Price excursions. Prices often tend to revert to the middle band, SMA. A close outside the band can signal strong momentum or an overextension. A price touching or breaking the upper band might suggest an overbought condition, while touching or breaking the lower band might suggest an oversold condition. Squeezes. When the bands narrow significantly, it's called a Bollinger squeeze, often preceding a breakout in night. Her direction. Moving Average Convergence Divergence, MACD. Crossovers. By signal, when the MACD line crosses above the signal line. Sell signal. When the MACD line crosses below the signal line. Center line crossovers. When the MACD line crosses above the zero line, it indicates bullish momentum. When the MACD line crosses below the zero line, it indicates bearish momentum. Divergence. Similar to RSI, divergence between price action and MACD can indicate weakening trends. For example, if price makes a new high, but MACD makes a lower high, it suggests bearish divergence. Combining signals. While individual indicators offer insights, combining signals from multiple, non-correlated indicators can lead to more robust trading decisions. For instance, a MACD bullish crossover combined with an RSI moving out of oversold territory might be a stronger buy signal than either indicator alone. However, remember that no indicator is perfect and all have limitations. Limitations of technical indicators. It's crucial to acknowledge the limitations of technical indicators. Lagging nature. Most indicators are derived from past price data, making them inherently lagging. They reflect what has already happened, not necessarily what will happen. This means signals often appear after a significant portion of a move has occurred. False signals. In choppy or sideways markets, indicators can generate numerous false signals, leading to whipsaws and losses if traded blindly. Context matters. Indicators should always be used within the broader context of market conditions, fundamental analysis, if applicable, and your specific trading strategy. A signal that works well in a trending market might fail in a ranging market. Not predictive. Indicators do not predict the future. They merely provide probabilities based on historical patterns. Unexpected news events or shifts in market sentiment can override any technical signal. Simple trading strategy, MACD crossover. To bridge the gap between analysis and actionable insights, let's consider a very basic trading strategy using the MACD crossover. This simple strategy generates a buy signal when the MACD line crosses above its signal line and a sell signal when it crosses below. We'll add a new column to our data frame to store these signals. Download the code on OnePageCode Substack. Here, code snippet is used for a simplified signal. For precise crossover detection, we compare the current MACD and signal values with their previous day's values using code snippet. A code snippet indicates a bullish crossover, buy, and code snippet indicates a bearish crossover, sell. Download the code on OnePageCode Substack. Now, let's visualize these signals on the price chart. We'll use marker points to indicate buy and sell signals. Download the code on OnePageCode Substack. This visualization adds green upward triangles for buy signals and red downward triangles for sell signals directly on the price chart. This immediate visual feedback helps in understanding how the strategy would have performed on the historical data. This simple strategy serves as a foundational example. In a real-world scenario, you would need to backtest, thoroughly test the strategy over a long historical period to assess its profitability, drawdown, and other performance metrics. Risk management. Incorporate stop-loss and take-profit levels. Transaction costs. Account for commissions and slippage. Market context. Consider other factors like volatility, market regime, and fundamental news. Beyond basic indicators, the code snippet library offers a vast array of other technical indicators, including moving averages, simple moving average, SMA, exponential moving average, EMA, weighted moving average, WMA, volume indicators, on-balance volume, OBEV, money flow index, MFI, trend indicators, average directional index, ADX, Ichimoku cloud, oscillators, stochastic oscillator, Williams %R. You can explore the code snippet library's documentation for a complete list and their usage. Other Python libraries like CodeSnippet or CodeSnippet also provide robust frameworks for building and backtesting more complex trading strategies involving multiple indicators and intricate logic. Summary. This section consolidates the fundamental concepts introduced throughout the preceding chapters, providing a concise yet comprehensive recap of forward and futures contracts, their distinctive features, pricing dynamics, and market conditions. Understanding these distinctions is paramount for effective risk management, speculation, and the application of quantitative analysis in derivatives markets. Forward versus futures contracts, a comparative overview. While both forward and futures contracts serve similar purposes, allowing parties to agree today on a price for an asset to be delivered or settled at a future date, their structural differences lead to significant implications for trading, risk, and market participants. Feature forward contract, futures contract. Standardization, highly customizable, tailor-made standardized, quantity, quality, delivery date. Trading venue over-the-counter, OTC. Market, bilateral organized exchanges, e.g., CME, ICE. Counterparty risk, significant. Bilateral credit risk, minimized by clearinghouse as central counterparty. Settlement, typically physical delivery or cash settlement at maturity, mark-to-market daily, often cash settled. Regulation, less regulated, highly regulated. Liquidity lower, illiquid high, active secondary market. Margin, no initial margin. Collateral, often required initial margin and variation margin required. The role of margin accounts and mark-to-market. A critical distinction, especially for futures contracts, lies in the daily settlement process known as code snippet and the associated code snippet. Initial margin. When entering a futures contract, both the buyer and seller must deposit in code snippet with the clearinghouse. This is not a partial payment for the asset, but rather a good faith deposit to ensure the party can meet its obligations. The amount is a percentage of the contract's value and varies based on volatility and contract type. Maintenance margin. Below the initial margin, a code snippet level is set. If the balance in the margin account falls below this level due to adverse price movements, the account holder receives a code snippet, requiring them to deposit additional funds, variation margin, to bring the account back up to the initial margin level. Mark-to-market. Futures contracts are code snippet daily. This means that at the end of each trading day, the contract's profit or loss is calculated based on the closing price. The gain is added to the margin account of the profitable party, and the loss is deducted from the margin account of the losing party. This daily cash flow effectively settles gains and losses, significantly reducing accumulated counterparty risk. This continuous settlement mechanism contrasts sharply with forward contracts, where profits and losses only materialize and are settled at the contract's maturity, exposing parties to the full extent of counterparty default risk throughout the contract's life. Futures and forward pricing. Key factors and formulas. The theoretical price of a futures or forward contract is primarily driven by the code snippet of the underlying asset, the code snippet, and the code snippet. Other factors like code snippet for storable commodities and code snippet for commodities providing a benefit to holders also play a crucial role. The fundamental code snippet provide a theoretical fair value for these contracts, while a full derivation involves continuous compounding and arbitrage arguments. A concise high-level reminder is useful. For a non-dividend paying stock or a non-yield-bearing asset, F nullo es IGRT, where code snippet equals futures/forward price today. Code snippet equals spot price today. Code snippet equals Euler's number, base of the natural logarithm. Code snippet equals risk-free interest rate, annualized, continuously compounded. Code snippet equals time to maturity in years. For commodities with storage costs and convenience yield. $$ F0 égale S0 E, R plus C, I, T au $, where code snippet equals storage costs as a percentage of asset value, continuously compounded. Code snippet equals convenience yield as a percentage of asset value, continuously compounded. These formulas represent the cost of carry model, indicating that the futures price is essentially the spot price plus the cost of holding the asset until maturity, financing costs plus storage costs, minus any benefits of holding the physical asset, convenience yield, or dividends. Deviations from these theoretical prices can signal arbitrage opportunities, though in highly efficient markets, such deviations are typically short-lived and minimal. Contango and backwardation. The relationship between the spot price and futures prices across different maturities reveals important market conditions. Contango. A market is in code snippet when the futures price is higher than the spot price, or when longer-dated futures contracts are priced higher than shorter-dated ones. This is the normal state for many commodities, reflecting the cost of carry, storage, insurance, financing. In a contango market, buying the spot asset and simultaneously selling a futures contract, a cash and carry trade, would yield a risk-free profit if the futures price exceeds the spot price plus the cost of carry. Backwardation. A market is in code snippet when the futures price is lower than the spot price, or when longer-dated futures contracts are priced lower than shorter-dated ones. This condition often occurs in commodity markets when there is an immediate high demand for the physical commodity, leading to a high spot price and a negative convenience yield. For example, during a supply shortage, the immediate value of holding the physical commodity, its convenience yield, can outweigh the cost of carrying it, causing futures prices to be discounted relative to the spot. Understanding contango and backwardation is crucial for traders and hedgers. For instance, a hedger rolling over a short futures position in a contango market will incur a cost, buying back a cheaper near-month contract and selling a more expensive far-month contract, while in a backwardation market, they would benefit from the roll. These concepts directly influence the profitability of various trading strategies and the effectiveness of hedging programs.